Good morning.
Good morning.
Thank you, Nancy. You knew what I was doing.
Yes.
We're on the record in case number 2020-00064, electronic application of Big Rivers Electric Corporation for approval to modify its MRSM tariff, cease deferring depreciation expenses, establish regulatory assets, amortize regulatory assets, and other appropriate relief. My name is Talina Matthews. I'm the commissioner here at the Public Service Commission, and I'll be presiding today. Joining me today via video conferencing is Vice Chairman Cicero, I believe I saw. Yes. And Chairman Schmidt will be watching live as well, and both will participate in the case. Due to the current state of emergency in Kentucky, the Commission is hosting this hearing via video conferencing. Since this continues to be a learning experience for everyone, there are a few suggestions I would offer. In addition to the normal courtesies of turning off or setting your phones to silent, these tips may help clarity and avoid feedback issues for the video conference hearing, remembering that our record is the recording of this. Mute your microphone if you're not speaking. Attorneys, when you interject, please state your name so the video record is clear. If you use a phone for the audio and a computer for the video, make sure your computer audio is turned off, otherwise there will be feedback. If you're in a room with several people and all are on their computers, turn off the computer audio for all but one computer, otherwise we'll have feedback. If you have another participant in a nearby office, close the door between the offices. Sound carries further than one thinks, which can be embarrassing and cause feedback. Once you're in the software platform, go to your settings. The icon looks like a gear to ensure that your microphone setting is on the microphone you're using. Settings will list the available microphones, and since we've tested those, I think we're good. When you can, use a wired headphone or earbuds for better sound quality. Wired is preferred because the wireless may lose power depending on the length of the hearing. Keep a charger nearby in case your battery runs low, and please alert the Commission if you're experiencing technological failure that prevents your participation at any time. The attorneys should contact staff at the previously provided cell number. The hearing today is for the purpose of taking evidence on Big River's application to modify its MRSM tariff, cease deferring certain depreciation assets, establish regulatory assets, and amortize existing regulatory assets. At this time, I'm going to back up here so I can see. We're going to have the entry of counsel, and because we're juggling a lot of people on this screen, it looks like the Brady Bunch, I will ask each party's counsel to identify their witnesses at this time. For Big Rivers.
Good morning, Your Honor. Edward T. Depp. I have the colorful background behind me here. Law firm of Dinsmore and Scholl for Big Rivers Electric Corporation. I have with me my colleague Brooks Herrick, who has the banner behind him as well. And we have 3 principal witnesses and 4 witnesses who sponsored data requests who are also present in case they are needed today. The witnesses who sponsored testimony are Robert W. Berry, Paul G. Smith, and Daniel M. Walker. And the data request sponsors are Lindsay Durbin, Mike Pullen, Mark Ekrit, and Mike Chambliss.
Okay, for the Attorney General.
Hi, this is Mike West for the Attorney General's office, and we also have John Horn as well, and we will not be putting on any witnesses today.
Thank you. For KIUC.
Morning, Your Honor. Mike Kurtz, Kurt Bain, Jody Cohn, Bain, Kurtz, and Lowry for KIUC. The 2 KIUC participating companies in this intervention are the 2 Western Kentucky paper companies, Kimberly Clark and Domtar. We're sponsoring 1 witness, Stephen J. Barron.
Thank you. And for Commission staff.
Morning, Commissioner. Making my debut, Kent Chandler on behalf of Commission staff. Appearing along with me is Nancy Bensel.
Thank you. I have been advised that public notice has been given and filed into the record. Is that correct?
That is correct. And Your Honor, if I may, I neglected to mention Tyson Cammett for Big Rivers as well.
Thank you. Are there any outstanding motions?
There is, Your Honor, a motion to tender a settlement agreement, stipulation, and recommendation that was unanimously agreed among the parties.
Thank you.
And Commissioner Matthews, there also are multiple confidentiality petitions outstanding.
I think that's typically the case, correct. Now we have our public comment period. The phones are on, correct?
I'll unmute them.
Okay. Should anyone from the public like to provide the commission with public comment? The phone lines are open. Should you call in, please state your name and address for the record before making your statement, and please keep your comments to 5 minutes. If there's more than one caller, please be respectful. It should be noted that comments may always be submitted on the website at psc.ky.gov. And I don't hear anyone on the phone. Okay, we're going to leave that open for a few minutes should anyone join us while we can get started with witnesses. We get started?
Just wait.
Okay. Wait. Good thing patience is mine. We're going to wait for a couple minutes just to see if anybody shows up. So I think we can see almost everyone. This is being live streamed, so should someone like to provide comments, they can always go to the website at psc.ky.gov and submit those comments on the record. Good? Okay. Mr. Depp, your first witness?
Thank you. Big Rivers calls Robert W. Berry.
Get his mic unmuted.
Okay, can you hear me, Commissioner?
I can. Would you raise your right hand, please? Do you swear or affirm that the testimony you're about to give is true and correct under penalty of perjury?
I do.
Could you please state your name and address for the record?
Yes, my name is Robert W. Berry. I'm the president and CEO of Big Rivers Electric. My business address is 201 3rd Street, Henderson, Kentucky, 42420.
Thank you. Mr. Depp, you may ask.
Thank you. Mr. Berry, did you cause direct testimony and settlement agreement and supplemental direct testimony in support of that settlement agreement to be filed with the commission?
Yes, I did.
And do you have any revisions or updates to those documents?
I do not.
And if I were to ask you today the questions that are in those testimonies, would your responses to those be the same?
They would.
Witnesses available for cross.
Thank you. KIUC,
No questions, Your Honor.
the Attorney General,
No questions.
Commission staff. Mr. Chandler?
I think Ms. Bensel has some questions for Mr.
Okay,
Berry.
sorry.
Yes. Thank you. Yes, we have a few questions. Good morning, Mr. Berry.
Good morning, Nancy. How are you?
I'm very well, thank you. I'd like to start with a couple questions about Coleman Station and Reed Station 1. Can you confirm that it is not economical or economically feasible for the Coleman Station to serve native load?
In the current market conditions, it is not economically feasible for Coleman to continue operation.
And Reed Station 1, is the same true that it's not economically feasible for Reed Station 1 to serve native load?
That's correct.
And in terms of the wholesale market, would you also say that neither Coleman nor Reed Station 1 are competitive in the wholesale market?
That's correct.
Thank you. One of the settlement provisions is that the rural customers would receive the new tier credit allocated on a per customer basis rather than a per kilowatt hour basis. Now, subject to check, we have testimony that says that the rural class consists of about 100,000 residential customers and about 18,000 commercial, and I'm going to call them small industrial to distinguish from the large industrial class. Given that, could you explain how a per customer credit is equitable to the commercial and industrial accounts in the rural class?
So the theory behind the customer credit is based on the fact that those are the folks that probably need the most help, specifically in the pandemic that we're in today. The theory was also that if we could relieve some of the rate pressure off of the rural customers or residential customers, that they would actually spend that savings and money at the local establishments, which would in turn still bring value to the larger commercial customers as well.
And was there any economic analysis behind that, or is it more of a policy decision?
It's more of a policy decision, and it was something that was recommended by the Attorney General, and we certainly support that.
Okay, thank you. Do any of Big River's loan covenants include any provisions that Big Rivers has to file a rate case if certain conditions are met? For example, if the MFIR is below a certain percentage over a defined period of time.
So Big River's loan covenants has a minimum MFIR requirement of 1.10. I'm not certain that they specifically say that we should file a rate case, but they do infer that we will maintain rates that would allow us to earn at least the minimum of a 1.1.
Okay. So it's more of an inference rather than explicit provision. But the underlying assumption is if the MFIR falls below that you would, of course, need a rate increase. Is that correct?
That's correct. That's my understanding. And Paul Smith can probably answer that question better than I, specifically of what's in the indenture.
Okay. Thank you. So Big Rivers proposes to file the new tier credit information no later than February 28th in each year that it's applicable. What is the last day that Big Rivers can alter its year-end financial statements?
I think we can alter that year-end financial statement up until the audit, financial audit that we perform, and typically that audit is concluded in April.
I don't have any more questions now. I may have something on a recross if I get something from my colleagues, but for now, no more questions.
Okay. Mr. Depp, do you have any redirect?
I do not, Your
Excuse
Honor.
me. Mr. Cicero, please, Vice Chairman, forgive me. I forgot to ask if you had any questions.
I knew you wouldn't forget me forever, so I waited patiently till you got to me. Good morning, Mr. Berry.
Good morning, Commissioner Cicero. How are you?
I'm just fine, thank you. So if I look at this whole scenario that's being proposed, this basically accomplishes a couple of different things, doesn't it? It improves your credit rating by improving your balance sheet, and you propose to help out your ratepayers because you've done a pretty good job of increasing off-system sales. Is that basically it?
I think it goes just a bit further than that, but I think that's a good general description. We're able to settle all the regulatory assets that are outstanding, which is important for the credit rating agencies to allow Big Rivers to regain its investment grade credit rating. It also allows some short-term and long-term benefits to the members. And then there'll be additional savings along with that for the members once we reestablish those investment grade credit ratings. Our interest expense has gone down from about 43 million a year in our last rate case in 2013. I think it's about 37 million now, and Mr. Smith in his testimony has identified some other interest savings in the future here that we plan to do shortly. So, and then it also gives the credit rating agencies the comfort that that we're going to have a stable revenue stream as well.
So I'm going to touch on the rating agencies just for a second and then go on with some other questions. But the rating agencies, and I think Ms. Vinsel asked when was the last date to make an entry for your books. From an accounting standpoint, a lot of this seems to revolve around your tier rating and making certain that the credit agencies are happy that your tier ratio appears to produce at least an operating environment that shows that the utility is healthy and is generating the type of revenue that it needs to and the type of income it needs to be viable and serve its ratepayers. And I guess one of the questions I had was, there seems to be a timing implication in this whole scenario that when the 1.3 or the 1.1, whatever it may be, is hit, that those extra funds are used to either be put into a regulatory liability, or I think as you initially proposed, that initially goes into offset the regulatory asset immediately, which there's an accounting question on whether that can be done. But from a regulatory rating agency perspective, why wouldn't they look at whatever the tier ratio is prior to making that accounting adjustment, so that I noticed here that it shows anywhere from the 1.9s into the 2 point somethings, which would show at least average health compared to other generators, electric co-op generators. Why is that? Why is there this timing that seems to be so important on this when it's made?
So I think the important piece of that is to confirm that the regulatory assets are being paid down on a real-time basis. That's the real big issue. And so the rating agencies will always look at our audited financial statement. That's what they use, official numbers that they will use. And so when we pay down those reg assets, then that reduces our tier amount. But they want to make sure that we're not reducing our tier amount where we will be below the 1.3, which is what we've kind of established that is a reasonable metrics. Typical, I'm sure you've read the case, the typical G&T, average G&T is about 1.59 tier. So we're trying to keep it on the low end, and we can do that as long as there's some stable revenue stream that protect us around that 1.3 number.
And I'm sorry to put you in the middle of an accounting question. This might be better for Mr. Smith, but from an accounting standpoint, the operating ratio is what the operating ratio is. And if the commission were to give a directive that said these monies can be put into a regulatory liability as part of this case, then the agencies, I would think, would look at that and say, okay, they're generating this kind of additional revenue. This is going to be used to pay down these regulatory assets. And the commission is saying that's what it's going to be used for, because Big Rivers Electric is going to generate, or at least by your forecast, you will generate well above the 1.3, at least during the next 5 years. Wouldn't you agree?
I would agree. Our forecast, we're going to earn well above that 1.3 over the next few years. I will tell you and I participate in all of the rating agency visits, and the rating agencies want to actually see that regulatory asset amortized down. So their concern is there's a regulatory asset and then a regulatory liability that at any time the commission could come back and say, well, we've got this pot of money over here, let's do something else with it, and it's never applied to the regulatory asset. And I'm not saying that's what would happen. I'm just telling you that's their concern. At least that's the way they voiced their concern to us. And Paul Smith can give you some more specifics regarding what the rating agencies prefer. But I do know for certain that they want to actually see that regulatory asset being amortized down on a regular basis, not just another offsetting account building.
Well, that's fair enough. I'm not going to pursue that any further. I think the commission is very happy that this is going in the direction it's going, because these regulatory assets had to be addressed sooner than later.
Sure.
And this is a way to do it. So I think we're down to how it's going to be accomplished and some of the variables that how they're going to be assigned and how we're going to go about it. I want to go to there is a portion of expenses that are excluded for regulatory rate making purposes, close to about I don't know if that was confidential or not. I think it might be on. Is that something you're excluded for regulatory assets on this one spreadsheet that I have? I think Mary Whitaker is on here. I'm going to ask her that directly. Can you unmute her, Jim?
Vice Chairman, I do believe I do believe some of the items were confidential, and we can move into a confidential session if you'd like to have a conversation about it.
I do want to ask some questions about those. So if they're confidential, can we go to a confidential session here for very briefly?
Yes. Candace? Okay, we are out. Mr. Depp, do you have any redirect on any other issues that are not confidential?
No, Your Honor.
The Attorney General, do you have anything additional?
No.
Mr. Kurtz?
No, Your Honor.
Ms. Vinsel, nothing?
Nothing further.
Commissioner Matthews?
Mr. Vice
Commissioner
Chairman?
Matthews?
Yes.
So if I could, and this will be, I'm sure Mr. Smith may be able to add something to it, but if he is not able, I would like to have a post-hearing data request that if there is a formula for how the 400,000 or 600,000 was determined and what was included or excluded, I'd like to see that.
Thank you. And as always, Mr. Berry, if we have a post-hearing data request, it will be given to you in writing.
Okay, thank you. And I think we've provided that information already, but we'll be glad to provide that to you.
Okay.
What's included in that 400,000?
Okay. And Mr. Berry, are you available to stay should someone have a follow-up question for you?
Absolutely.
Okay, thank you. I think for now, this witness can be excused.
Thank you.
Mr. Depp?
Thank you, Your Honor. Big Rivers calls Paul G. Smith.
Good morning.
Good morning. If you'd raise your right hand, please. Do you swear or affirm that the testimony you're about to give is true and correct under penalty of perjury?
I do.
Could you state your name and address for the record?
Yes, my name is Paul Smith. I am the Chief Financial Officer for Big Rivers Electric Corporation. Business address is 201 3rd Street, Henderson, Kentucky, 42420.
Thank you. Mr. Depp, you may ask.
Thank you. Mr. Smith, did you cause direct testimony and supplemental direct testimony in support of a settlement agreement to be filed in this matter?
Yes, I did.
And do you have any revisions or updates to that testimony?
No, I do not.
And if I were to ask you today those same questions, would your answers then be the same?
Yes, they would.
Witnesses available for cross.
Any cross from the Attorney General's office?
No, we do not have any.
Mr. Kurtz?
If you don't mind, Your Honor, I will. I was going through some documents. Mr. Smith, will you turn to paragraph 4 of the settlement agreement that Vice Chairman Cicero was asking Mr. Berry about?
Yes, I have it.
Okay, so what are the 3 categories of costs that Big Rivers is allowed to incur, and it counts toward this 1.30 tier?
Yep. So the exclusions in this particular case are economic development, promotional advertising, touchstone energy, and then lobbying and donations.
Well, no, it says you're able to include those not to exceed 400,000.
That's correct. So that's correct. So the regulatory exclusions includes the broader bucket, and then we're excluding the 400,000 of the economic development, promotional, and touchstone that you cited.
Okay. Do you have the public version of response to staff 2-7B? I think the historic is public, and I don't want to ask you about the forecasted, which is confidential.
Yep, I can discern the two.
Okay. For 2019, how much was the promotional advertising actually incurred by Big Rivers?
72,000.
And what did that money go towards?
Various local events and causes.
How much was the economic development in 2019?
132,000.
And what did you spend that money on?
Would have been a variety of economic development across the 3 member owner service territories.
Does that intended to help consumers?
Absolutely. Would have included expenditures related to the acquisition of the Nucor load.
And how much was Touchstone Energy dues?
Touchstone Energy dues was approximately 121,000.
So those 3 categories add up to about 320,000.
Correct.
Those are categories of costs that are excluded in a general base rate case. Is that correct?
That's correct.
Okay, but you're including it in the 1.30 tier here. In other words,
That's correct.
okay. And if you excluded them, like you would in a base rate case, you would earn less than a 1.3 on a regular basis.
That's correct.
Okay, one last question. On the 401k match for defined benefit plan participants, how much money was involved in 2019?
Approximately 107,000.
For the 31 employees?
Correct.
Thank you, Mr. Smith.
Is that anything further from you? Mr. Chandler?
Good morning, Mr. Smith.
Good morning.
I'll come back to the retirement benefits / regulatory exclusions later. So don't think you're not getting any questions on it. But I'd like to first start with demand side management. Are you aware of, at least generally, of the demand side management? Excuse me, the demand side management regulatory liability that currently exists on Big River's books?
Yes, generally. Uh-huh.
Okay, and do you understand how that regulatory liability, and not just how it was created, but how it was created and how it's currently being funded?
Yes, I am.
Okay, and so do you understand it to be that there was a specific amount, well, it's a ballpark, about $1 million a year, that was included in Big River's base rates from the last, I guess, the 2013 rate case, that for which the company is only spending about $250,000 on DSM now. Is that how you understand the regulatory liabilities created?
That's right. Mr. Akret manages those programs, but generally those are the amounts I recall.
Okay, and so I think the application discusses the regulatory liability in terms of approximately $700,000. Do you all know? Well, a couple questions. Are you all proposing to stop booking the regulatory liability as of the order in this case, or as of December 31st, 2020?
I believe the date was in 2020, so we would probably do it as of January 1st, 2020.
Okay. Do you all know what you anticipate the regulatory liability amount to be at the end of 2020?
So it'd be an additional roughly 750,000.
Well, so I guess so you all said in the application it was approximately 700,000. Is that year end 2019 700,000?
That's correct.
Okay, so the approximately 700,000 is the year end, not what it was when you all filed your application in this case necessarily.
That's correct.
And do you all constantly, and I say constantly, at month end, when you close books at month end, are you booking to this regulatory liability, or is it an in-year accounting?
Yeah, I believe it's throughout the year, and again, some expenses, are delayed a month or two, so the timing may be impacted by kind of when those expenditures are actually paid, but roughly they're ongoing throughout the year.
So the expectation is by the end of this year, this regulatory liability that you all are proposing to use to offset the regulatory assets, the smelter mitigation regulatory assets, it will be approximately $1.5 million, not approximately 700,000.
So the proposal is to use the 700,000 that existed at the end of calendar year 19, and then to discontinue occurring additional regulatory liability in 2020. So that 750,000 would roll through the new tier credit, MRSM. So roughly half of that would go to the amortization of the smelter's reg asset, and the other half would become a bill credit.
Okay, and so do you all have the per books December 31, 2019 amount that you can provide instead of an approximate number?
We would, yes.
Okay. We're going to ask that as a post-hearing data request. So do you understand, are you aware of the Commission's 2018 order in 2018-236 that created that regulatory liability?
No, I think that's probably a better question for Mr. Akret.
Okay, so I'm going to ask it of you. Brenda, could you possibly bring up that 2018-236 final order?
Was that one of your files?
Nancy sent that yesterday in a separate email.
Oh.
Sorry, excuse me, Ms. Vinsel sent that yesterday in a separate email. Thank you. And could you mind to go to page 9 of the order? and then just up just a bit so we can read the entirety of that second paragraph. And Mr. Smith, can you see that paragraph that begins with "the commission finds it's reasonable"?
Yes, I can.
Okay. So I'll read it to you just so that do you see the paragraph that states the commission finds it reasonable to create a regulatory liability for the unspent portion of the $1 million of DSM revenues? However, the commission notes that since those DSM revenues are being collected only in the rural base rates, the regulatory liability should be used in BREC's next rate case exclusively for the benefit of rural customers. Further, the commission finds that a decision on the particular use of those funds to benefit rural customers in BREC's next rate case should not be made at this time, but rather defer to that next rate case. Do you see that?
I do.
Okay. So I think that you all noted that this is not a rate case, but you're nevertheless proposing to use the DSM revenues. That aside, what evidence have you all provided that the regulatory liability should not be used for the exclusive benefit of the rural base rates?
Well, I think a couple of thoughts came to mind, again, in the mutual settlement among all the parties, including the Attorney General and the KIUC. A couple of key factors here were in our MRSM, the allocation of any surplus is passed back proportionate to revenues in the prior year. The rural customers represent roughly 75% of our revenues. So the amount that would be passed back would be roughly 75% of this amount that you're reflecting. So there's an automatic 75% pass back to them here. Then the other considerations had to do with items such as there's been growth on the industrial side that'll get shared 70% to the rural class. So this was kind of a mutual meeting of the minds of how best to utilize the funds and balance out those benefits across the two classes.
But as the industrial class grows, so will their share of the revenues, right?
It'll depend on the profitability. So I'll look to off-system sales type events this year. Without growth in the industrial revenue, the residential or rural customers would see roughly 75% of the margins that were created by those incremental off-system sales. So it's kind of a balancing of what's happening going forward that are creating these surplus margins that we're trying to share.
So just to be clear, the commission said for the exclusive benefit of the rural customers, and the proposal here for BREC is for the rural customers to join in on 75% of the benefit.
And then in addition, to get 75% of what's created by the large industrial class to create surplus margins as well.
Well, and so this is money, right? Let's talk about two different ways. One is the regulatory liability, which is exclusively things that the rural customer are paying, right? That they've paid in over the last year or over the year of 2019 that are now going to pay down the regulatory assets, and I guess you could say arguably for the benefit of the system, right? We're not trying to split. But then what you're talking about is a separate issue, which is going forward from January 1 of 2020 on, you're talking about the revenues that are going to be charged to the rural class, brought through Big Rivers, any of those in excess of 1.3, or in the event those add to the amounts over a 1.30 tier, then roll into a credit where they're split 50-50 between paying down the regulatory assets and going to a tier credit, wherein they're split again 75-25. That's what we're talking about. Taking all the entire amount of the money at the beginning of the year and then doing that with it. That's what you're discussing, correct?
That's correct.
Okay.
So for my benefit, let me interject here for a second. For my benefit, Mr. Smith, you're saying that Big Rivers was aware of the order and how the commission determined that the DSM liability should be looked at and decided that based on this whole settlement, that you were going to appeal to the commission to overlook this directive, or what was the thought process?
Yeah, so when we met with the various parties, the Attorney General and the KIUC in advance of our filing, we talked about the issues that were out there. We talked about potential middle ground that would appease everyone. And this particular liability came up. We decided it was probably not in the best interest to continue just to grow the regulatory liability, but rather to put it to use, both to reduce the regulatory assets and to enhance the member bill credits. So that was kind of the discussion among the various parties on what was mutually agreeable.
So in hindsight, would you say that since the 2019 funds that were generated were exclusively from the rural rate makers, that at least the 2019 shouldn't have been proposed as a pass back directly to the rural rather than shared with the industrial, regardless of what happens going forward?
Yeah, well, I also looked to, we took a glance at what had happened over the last 7 years on the growth side, and there hasn't been much growth in the way of the rural class, but the large industrial has enjoyed pretty solid growth. Plus, we've got a couple going forward, the new core and an economic development rate customer. So there was, again, this kind of exploring what created the surplus that we're enjoying these days, as well as what's going to happen down the road. And rather than start to carve up everything as to whether it ought to be 100% rural versus 100% large industrial, we just kind of went towards that sharing concept of a revenue-based allocation.
And I understand what you're saying. I'm just curious on the 2019 where it's already in the books, it's already been paid for by one rate class, why those monies should be shared when you're speaking primarily to going forward. And I understand your statement during the past 5 to 7 years, the industrial base has grown, but that's kind of where this excluded from rate making and your lobbying and economic development money goes to improve those sales to the industrial side. I just wanted clarification. I'm not really asking, I didn't mean to interrupt Mr. Chandler's cross-exam. It was just, I'm curious why the 2019 wouldn't be looked at from a different perspective.
Yeah, no, a fair question. So the discussion we had regarding 2019 was it's an existing regulatory liability, and therefore we decided we built up the regulatory assets, and therefore just the netting of those made a lot of sense. It was the prospective 2020 and going forward that we got into the let's just share it based on revenue concept. So your point's very valid in one we discussed, which was how to apply 2019, and we thought it best to maintain that regulatory liability kind of characteristic, but then to net it against the regulatory assets that have been building over the last 7 years.
I'm sorry, Mr. Chandler.
Yeah,
please continue.
No, the conversation did bring me to another question. So the proposal is to share margins based off of allocation of revenue in the previous year, but revenue is not necessarily an indication of or correlate directly with margins, correct?
That is correct.
So insofar as you've had this steady residential customer base, which has been fairly steady, we'll say, since the beginning of Big River's time, and an industrial base that ebbs and flows historically for Big Rivers, would you say that the margins for the residential customers are fairly consistent and the margins for the industrial customers, particularly as it relates to economic development load, varies?
I would. Just to clarify, though, we have no component of economic development costs in our current rates. Those were excluded in the 2013 case when we set our our base rates.
Yeah, and excuse me, I didn't mean to indicate capital E, capital D, capital R rates. I mean rates proposed to customers or to new industrial loads or to even off-system sales for that matter, right? Those margins typically larger or smaller than they are for your rural base?
Yeah, I would say the rural is typically a little larger, but they have peaks and valleys to them throughout the year. The industrial's more levelized throughout the year. So they both have their upside and their downside. So as a utility, you try to find the right mix of the two, but given your service territory, it may or may not be helpful. But I do see benefits to both classes.
Yeah, but I guess what I'm trying to get to is that you're proposing to pass this back on the basis of revenues, but you're proposing to pass back margins on the basis of revenues, not margins on the basis of margins.
That's correct.
So, I mean, isn't there an inherent disconnect between those two?
Without going through all the analytics of trying to calculate what the margins are by specific classes, which might be a little tougher, but I do see your point.
And I just want to make clear that the $750,000 we're talking about is by definition a margin, because we know exactly the amount of revenues, or at least approximately the amount of revenues that are coming in for this item, about $1 million a year, as opposed to the explicit cost, which is $250,000.
I agree, and thus the roughly 75% of that 750,000, so roughly 550 to 600 of it is by default going to the rural class. I think we're talking about the last 100,000 in that amount.
Yeah, but I just want to make sure we're clear. We're effectively talking about residential customers giving you $1 and you giving them 75%. Or they're giving you $1, you're spending 25 cents of it, and then they're only getting 75% of their change back.
Yeah, I agree if you're going to segregate all your sources of revenue, but then going forward, we could also say when the economic development rate customer goes to full tariff, it's not going to be a change in revenue, and yet that'll be shared. 75% of that economic development customer margin will then be passed through to the rural class.
Right. Are you all explicitly asking the commission to re-examine or change their ordering paragraph number 7 in that order? And if Brenda, if you'll scroll down to ordering paragraph number 7. The commission explicitly ordered that BREC shall establish a regulatory liability for the benefit of rural customers only in an amount that reflects the difference between BREC's future DSM expenditures and the $1 million included in rural base rates. So it says the regulatory liability for the benefit of rural customers. Are you all asking for that to be amended so that the regulatory liability is for the benefit of the system as a whole?
Yeah, I think we're in looking at the settlement package in totality. This is one of those components. And yes, I think we are proposing that it be handled per the settlement.
So moving on, thank you, Cabrinda. Moving on, in response to staff DR1-10, you indicated that you are amenable, on behalf of Big Rivers, you on behalf of Big Rivers indicated you are amenable to including the amortization of the smelter loss mitigation regulatory assets as an explicit component of the calculation of the proposed new tier credit. Do you remember that?
I do, that's correct.
And I think that Mr. Walker has discussed this issue. I think maybe you've even said something in response to staff DR1-25. And then you mentioned this again in your settlement testimony on page 3, I believe, lines 10 through 14. And let me get to that and I'll read it off here. you stated in your settlement testimony, for any year in which Big River's tier is below 1.30, Big Rivers will reduce the amortization of the smelter loss mitigation regulatory asset in an amount that allows Big Rivers to achieve a 1.30 tier. In any such year, which Big Rivers is not forecasting to occur in the near future, Big Rivers will not provide the monthly bill credit. Do you remember saying that?
I do.
All right. Are you aware of ASC 9834025-1?
Yes.
Okay. And would you agree that in response to questions from commission staff at an informal conference that you all filed, and we'll get to it later, that Big Rivers filed on June the 3rd, and more than, actually, it's not an illustrative example. It's an actual example based off the forecast of this matter, where you implicitly did recognize the amortization expense of, I don't know if I can say the number or not, but that you put the amortization expense as an explicit amount in the calculation of the tier credit. Do you remember that?
I do.
So how does your all's proposal comply with ASC 9834025-1?
Yeah, so regulatory assets and liabilities they're kind of an unusual item. But in this particular case, it foremost focuses on the matching of revenues and expenses. And in this particular case, we'd be matching the revenue kind of bottom line and the expense item associated with it, the amortization. We would match those two items in the explicit presentation of that amount. So that amortization rising and falling kind of fits what you typically see in regulatory assets and liabilities, such as fuel clause calculations or storm damage and those types of things.
Sure, but let me ask it this way. Sorry, industry, regulated operations. So 9834025-1 specifically says that based on, this is B, based on available evidence, the future revenue will be provided to permit recovery of the previously incurred cost, rather than to provide for expected levels of similar future costs. Now, that first sentence would be, arguably, I think you all have argued that by including it as an explicit line item in the calculation of the tier credit, you've satisfied that first sentence, correct?
Yes.
But it also says, the second sentence of B says, if the revenue will be provided through an automatic rate adjustment clause, this criterion requires that the regulator's intent clearly be to permit recovery of the previously incurred cost. In any year in which Big Rivers does not attain a 1.30 tier, Big Rivers will not be incurring the amortization expense in its entirety, correct?
Well, again, I'd go to the matching. You have to be sensitive. In a regulatory asset environment, it's rarely within the same year that it's incurred. So these regulatory assets have been incurred over the past 40 years in theory. Those investments that were made in Station 2, Coleman, Reed Unit 1, those were 40 years worth of investment that we're now actually recovering. So it's very similar to a depreciation expense that one year might be a 3% rate, but if you do a depreciation study, it might change to 4% the next year. That doesn't mean the 3% the prior year was incorrect. It just means that the current level is the appropriate matching of that particular item, and that's consistent with what we're doing in this particular example.
So a couple of items. You would agree depreciation is governed by a different accounting standard, correct?
I would. Yes.
And you would agree that a change in Big River's depreciation rates would be explicitly approved by the Public Service Commission, correct?
I do agree with that.
Okay. And we will come back to that June 9th, or June 3rd filing, excuse me, I think today's the 9th. The June 3rd filing later when we go into the confidential session. Can you explain as it relates to, and I think Mr. Barron touched on this for a bit in his direct testimony, but I don't believe that Big Rivers has addressed it necessarily. How Big Rivers, how equity is created and how it grows beyond the required level as it relates to Big Rivers?
Yep, so each year our net margins will increase our equity level. So over a number of years, that equity level represents effectively the cumulative net margins, less any patronage capital or distributions or those types of, or other write-off type items that would have impacted it. So the equity is kind of the cumulative number of all those activities and transactions.
So let's talk about it a little deeper than that, though. So the proposal here is for your tier to be set at 1.30, correct?
That's correct.
Is the entire amount of whatever amount it takes to get to 1.30, is that for equity purposes considered to be your net margin?
Yes, it is at the 130 level. That's right. Roughly 11 million a year.
So as I say, let's make up a number, $11 million a year, right? So if in 2020 it's going to be $11 million a year, the entirety of that and it's not cash, it's not a cash, just for book purposes, the entirety of that $11 million net margin at 1.30 tier becomes your addition to equity?
That's correct. And it may or may not be cash. You're correct on that.
And how much are you required in any given year of net margins to add to equity?
50% is our requirement.
And what is that? Under what documents is that a requirement?
It's in our credit facility document.
Okay. And has that been recently amended?
It has.
And did that term stay consistent?
It did. One clarification, the previous was approved, I'm going to say in around 2014, and it started with a beginning balance and said 50% of the annual amount. So every year we were looking off of 2014 and adding the subsequent years. When we amended and restated that credit facility recently, we updated it to the 2018, 2019 actual number. And so it's kind of been updated, but using exactly the same math and the same number you would have seen from the previous credit facility language.
And so just to be clear, is it 50% of that given years has to be added to equity, or 50% of 2019, each subsequent year has to be added to equity?
Each subsequent year. So there would, I'm going to forget the number from the most recent one, but let's call it 425 million or thereabouts. We would then add 50% of the 2020 net margins, and that would become our kind of calendar year 2021 ending minimum equity requirement.
Okay. But just so I understand from the settlement, you will continue to book the entirety of net margins to equity in any given year?
After the tier credit's been applied, so at the 1.3 level, that's correct.
Correct. Okay. And is your credit facility also the document that sets the requirement for what your minimum equity amount is?
It sets the minimum equity. Our indenture sets the minimum MFIR requirement.
Okay. And so for your minimum equity, you all are proposing to take your minimum equity, right? And whatever you have net of that, in excess of that, you're proposing to use 80% of that excess to write down the regulatory assets.
That's correct.
And I think
January of 21. That's correct.
okay, so you all know with reasonable certainty what that amount is, and I think it's been thrown out as approximately $91 million, correct?
That's correct.
So 91, sorry, I don't have the numbers in front of me. Extra 20%, 18. It's $100 million you have in excess.
That's correct. 113.
113.
That's right. That's our forecast. That's right.
113 that you have in excess of what's required. If you are proposing to earn a 1.30 tier in every given year moving forward until you have a subsequent rate proceeding, right? Then by definition, will your equity only grow? Yes. By the 0.3 times our interest. It'll vary by
what your interest expense is, because the tier is a times a multiplier of your interest expense. So you're correct, but the amount will vary by year.
Right, the amount will vary. I just want to make sure directionally it can only increase.
That's correct.
What's the benefit of the 20% cushion, or I won't call it a cushion, only using 80% of the equity headroom to write down the regulatory assets?
Yeah, that was just the discussion with the Attorney General and the KIUC to leave sufficient headroom just in case for those uncertain events that can happen at any point in time.
Yeah, my point is, what's the benefit of having that excess 20%? If it's expected in subsequent years to only increase, and it won't be diminished because you're proposing effectively you're proposing an automatic rate adjustment that guarantees a 1.30 tier in any given year. What are you guarding against with an additional 20% over the minimum requirement?
Yeah, I would say my biggest fear would be things that retirements of units, some larger dollar amounts that maybe we don't have sufficient amortization to offset. So if we have an annual amortization amount, I just don't foresee the commission saying that we should undo, I'll throw out a number, 10 million of amortization, and then add an additional 50 million for any one-time event and call that a regulatory asset.
But I want to be clear. What you're saying is if you have an expense that is not provided regulatory accounting or cannot otherwise be amortized, that's your issue, right? Is that you're worried about the hit to the bottom line of a one-time expense that is not otherwise booked.
That's correct.
And so what do you have available that you are worried about the commission not granting deferral accounting for that can happen in any given year that would, that you would need? So what's that cushion? 20 million, 20, 30, $25 million for approximately?
That's correct.
What's the fear? I mean, so you said a retired generator. You're proposing to retire 2 generators effectively in this case, and you're proposing to book them, correct?
That's correct.
So what is it that's the concern?
No, it'd have to be a catastrophic kind of event. So, again, tornadoes can cause situations, pandemics can cause situations. There's just a lot of kind of unexpected events that we're just being sensitive to in this particular case.
Let's move on to TIER versus MFIR. So TIER stands for time. Well, go ahead and tell me what TIER stands for.
Yeah, TIER is times interest earned ratio.
And MFIR?
Margins for interest ratio.
And your covenants require you to calculate an MFIR in any given year, correct?
That's correct.
So at least one data request indicated that the only difference between MFIR and TIER is the inclusion of income tax, but that's not necessarily the case, right?
In addition to extraordinary items.
Okay, and extraordinary items are included in MFIR or are not included in MFIR?
That's correct. They're included.
They're included.
Or excuse me, I'm careful how I include. It's an add back to the MFIR value.
Okay, so and I can speak with Mr. Walker about this in more in depth later. But it was my understanding. Well, I'll say it this way. I believe it was 2014 and 2015 TIER and MFIR were different. Is that?
That sounds right.
And the difference was interest expense, right? Income tax. Excuse me, income tax.
Income taxes. There also were a couple of settlements in some litigation, I think, in one or both years as well.
Is there a rule in which you can determine whether tier or MFIR is always going to be higher than the other?
I've got to think about a case where income taxes have a benefit. For instance, in 2020, we have an income tax benefit. I'll have to check whether you actually reduce MFIR for that if you take out that benefit. But in general, I think it's safe to say that MFIR will always be or generally be higher than the tier.
MFIR
big
higher
rivers.
than the tier?
Uh-huh.
Okay. So that was my impression after looking at staff DR 210. Mr. Walker was explaining the difference in MFR between, or the difference between MFR and tier for Corn Belt. Are you aware of that portion of his settlement testimony?
No,
Okay,
I'm not.
I'll speak with Mr. Walker about it. That's fine. So let me get through a couple of these non-confidential questions, and we'll try to do all of it confidential at one time. Have you discussed, or has anybody at Big Rivers, to your personal knowledge, discussed the per meter credit with Kennergy, Meade, and Jackson Purchase?
Yes.
And have they made representations about the per meter credit?
Yes, all three of our members are supportive of that settlement provision.
So let me ask a more direct question. Are they supportive of it or indifferent?
Their only concern was the any billing system implications. Could they handle it? I don't know if it was a phone call, so I don't know that I could distinguish, body language of whether it was indifference or supportive. They were certainly not opposed.
Okay. So on page 6 to 7 of your settlement testimony, you noted that the difference between a 1.30 tier and a 1.10 MFIR, which I assume you're assuming that the tier and the MFIR are identical in that sentence, correct?
That is correct.
Is only approximately $7 million.
That's correct.
So, this is going to be a silly question. Are you indicating in that every 1/10 of tier is worth approximately $3.5 million under Big River's current financials?
I'll have to check that. Yes. Our interest expense is roughly 35 million. So I would think 3.7 million per tenth, if that makes sense.
3.5,
For each point.
3.7. So
Yes.
So on that, then, if 1/10 of tier is approximately $3.5 million, on the next page, on 7 through 8, you discuss that a 1.31 tier is approximately $11 million. That assumes that 0.1 of tier is approximately $780,000, $800,000. Right? If 1.30 tier is $11 million a margin, $11 million divided by 13 is approximately $800,000.
That math is correct. Yes.
The math is correct. So can you help me here understand which one of them is right? If 1.3 is 11 million, then I don't understand how the difference between 1.1 and 1.3 is 7 million.
Yeah, I'll have to check that and get back to you.
Okay.
I certainly see the question.
And so we're going to ask that you check page 6, page 7, page 8 to make sure that it's first accurate. But second, we're going to specifically ask a post-hearing data request as to what margin 0.1 of tier under your current calculation, under your current financials, or we'll say probably end of year 2020 will be. But then also what it's going to be expected. What can you all do a forecast through 2026 for what your expected interest expense is going to be? I mean, you all, I assume, already have a placeholder for those.
We do, not under the assumption of the settlement, but it's very similar. It's typically capital driven, so we typically would know that.
So we're going to ask for each year through 2026 for what that 1/10 of tier looks like in any given year, using the assumptions of the settlement agreement, so that the commission can understand what that margin looks like at 1.1, a 1.3, or 1.5, but also that we understand what's being added to equity. Correct?
That makes sense. Yes.
Yeah. So can we go to page 11 of your settlement testimony? And particularly page 11, line 16.
Yes, I have it.
So line 16 states, so let me take a step back. You're talking about Moody's here, and Moody's is the only one that's not given Big Rivers an investment grade credit rating, right? Or Moody's is someone who has not given Big Rivers an investment grade credit rating, correct?
Moody's has not. That's
Moody's
correct.
has not. In a report, they specifically, this is your language, in the report, quote, specifically noted the commission's support of a 1.30 tier as one of the credit positives, stating, and this is Moody's quote, the KPSC rates approved in the April 2014 rate order are designed to enable Big Rivers to achieve a 1.3 tier, a level that is 20 basis points higher than the 1.1 times margins for interest. Essentially the equivalent of tier. They're talking about MFIR. Essentially the equivalent of tier, required as defined under Big Rivers indenture. The additional revenue amounts to support Big Rivers tier at 1.3 times is credit positive because the amounts help to partially offset certain other costs not recovered by the approved rate increases. So specifically, in the 2013 rate case, the 1.30 tier being in excess of the 1.1 indenture requirement served at least two purposes. One, that it provided a cushion for those rates in the future that were unexpected or were unexpected levels, but it also provided for recovery of costs not explicitly approved but expected to be incurred in the rate case, correct?
That's correct.
In this matter, you're proposing only to incur, let's say, $180,000 of costs that are not going to be realized in the calculation of the tier, correct?
I'm not familiar with the 180,000.
So approximately $580,000 of regulatory exclusions net of the 400 you're allowed to recover.
Actually, our regulatory exclusions on an annual level are right around 500,000.
Okay, so we're talking about $100,000 of expenses you expect to incur but will not recover. Otherwise,
that's correct.
The calculation as proposed will cover all costs, all expenses in any given year.
That's correct.
So a 1.30 tier now is far more generous than the 1.30 tier used in the 2013 rate case.
Yeah, we're kind of mixing what was allowed in rates versus what are you now using to calculate what your credit in MRSM is going to be. But I
Well,
get your point on that.
let's take it this way.
Similarity.
So in terms of exclusions that were not allowed for rate making in the 2013 rate case, like things that the commission probably expected you to continue to incur, but did not allow for rate making purposes, you would agree that your proposal in this case, those amounts are lower.
Yes,
But the tier is identical and the indenture requirements are identical.
that is true.
And you would agree that between 2013 and I guess even today, if you incur costs that were not at levels or that weren't even identified to be incurred in the 2013 rate case, you take the risk that those exceed the cushion between a 1.1 and a 1.3.
Yeah, now, again, we got to probably think about it a little bit on a larger scale. I think about the rate design has an impact to us as well, that we're trying to cover off in this particular provision. So we need to be sensitive to things that will go against us going forward, as well as things that will be helpful going forward.
And that's fair enough. We can talk about how the pie's cut or how it's recoverable. We're talking about actually the sort of revenue requirement soup, right? Let's talk about that first. Specifically, if you incur costs in a later year that are, who knew a 100-year pandemic was going to come this time last June, right? But if you incur costs going forward under the current proposal of what's proposed here, those costs will be allowable for the calculation of the 1.3 tier. Whereas for the last 7 years, if you incur costs in amounts or in type that were not anticipated, those are not reflected in the revenue requirement.
That's correct, assuming revenues were the same, et cetera, right.
So the purpose of this case, one of the primary purposes, is to begin the pay down of the regulatory assets, correct?
That's correct.
The creation of and the amortization of those regulatory assets. Would you agree that in any year in which Big Rivers doesn't reach a 1.30 tier, that those regulatory assets will not even, that those regulatory assets will be amortized at a pace that would not allow it to reach full amortization by 2043?
I'm sorry, could you repeat that?
So, would you agree? So let me take a step back. The amortization amount that's included in the calculation of the tier credit is the amount of amortization required to amortize the regulatory assets by the end of the all requirements contract, correct?
That's correct.
Would you agree that in any year in which you, Big Rivers, does not reach a 1.30 tier, that you will not amortize at that necessary rate?
That's correct.
And you would depend then on the amounts, that extra 50% to pay down quicker in those years in which you do reach a 1.30 tier or exceed a 1.30 tier to amortize it on time.
That's correct.
What does your FFO to debt and debt service coverage look like in the near-term horizon through 2026? I don't mean numbers. I just mean objectively, how are they going to be viewed?
Yeah, they're solid.
Are they
Very
better
solid.
than they were the last few years?
That's correct. So we saw a trend from 2017 up to 2019 increasing, and they'll be relatively flat from 2019 through the foreseeable future.
And so would you agree that the FFO is benefited by larger margins that increase free cash flow?
Yeah, they're benefiting by the amortization expense, which is excluded as a charge from those calculations. So, yeah, the additional amortization is kind of what's helping those calculations going forward.
So from 2020 to 2026, do you expect your FFO to debt ratios to increase or stay steady?
No, fairly steady. The real key to that one is driving down the debt load and the interest costs, but let's call them roughly steady over that time. But we'd like to see them kind of improving as interest and principal payments decline.
So let me ask about how the calculation of the tier credit relates to the FFO to debt ratio. Since you're not actually earning the higher tier in any given year, you're only actually earning the 1.30 tier. Is the pass back of those credits, the 50% over the net margins or 50% over 1.30 tier, are those taken out prior to the calculation of the FFO to debt?
They are a reduction in the FFO to debt because those are a cash flow, kind of an outflow. They're not in the year incurred. In the year, they're actually paid back in the form of a bill credit.
Yeah, and so you're paying back the subsequent year for the previous year's credit, is that right?
That's correct.
And so are you going to have a spike in 2020 in your FFO to debt ratio?
No. So one provision of the settlement, more of a nuance is we're retaining the current MRSM kind of bill credits for things like the Hawesville transmission credits. We're continuing to pay those this year in the year that we receive those funds. And then we're doing the transition at the end of the year for the excess. So we're going to finish the year with a surplus margin that'll fund next year at a level actually higher than what this year's bill credits would be. So if you go year to year, bill credits would be 10 million this year, and they'll be higher next year.
So let me ask a related question. So if the bill credit at 50/50, the actual cash that's being passed back to customers is a hit to your FFO to debt, right? That because in any given month you're going to have all this great free cash flow from operations, but you're simultaneously coming in the front door, but you're simultaneously passing a credit back out the back door that's a cash hit, right? Or a hit to cash. But your debt service coverage is a book amount, not necessarily a cash calculation. And we know about tier. Are the Moody's and the S&P's going to be looking at what your books look like prior to passing back and paying down these amortizations? Are they going to be, if you earn a 2.50 tier, and then you cause yourself, pursuant to your mechanism, to only earn a 1.30 tier at the end of the year, right? There's that 1 second that all of a sudden you went from earning a 2.5, you do a single accounting entry, or you know what I mean, a swift accounting entry, and you're now at a 1.30. Are they gauging you off of the for debt service coverage tier? Are they looking at you in terms of health prior to that accounting entry or after that accounting entry?
No, absolutely after on what our financials are reporting. The two numbers we have to keep in mind is half of that reduction from the kind of unadjusted tier down to what the reported tier will be. Half of that's an amortization expense, which they don't take into account. The other one that's critical in these calculations and ratios going forward is we're going to begin recognizing the depreciation expense at the Wilson station. So you've got an incremental roughly 20 million of amortization expense going forward that is favorable for your cash flow metrics. So we're counting on that Wilson charge that's in that both numbers that you were referring to on the tier, but that's a non-cash expenditure. So we're, again, playing off of we've got amortization expense, not cash flow expenses going forward. So our earnings may not be as healthy as they otherwise could have been, but our cash flow still looks very solid to the rating agencies.
Okay. They're book transactions, not cash transactions, is what you're saying.
They are, book depreciation being a book, and I'll throw something out. The 10 million of reg asset amortization plus the 20 million of the Wilson depreciation, we're actually booking and going to incurring $30 million more per year in depreciation expense than what we've historically booked. And that's why the cash flow metrics will look positive to the rating agencies.
For the cash flow metrics, depreciation and amortization are treated identically. Is that right?
Exactly.
Okay. Commissioner. It's 10:30. Do we want to take a break before we do all the confidential questions?
Yes.
10:40.
Let's take a 10-minute break. We'll start back at 10:50.
Thank you.
Okay. And we are back in 2020-0064, and I believe Mr. Smith is still on the stand. Mr. Chandler?
Can you hear us, Mr. Smith?
He's ready now.
Goodness. Yeah. Paul, are you live?
I am.
Okay, thank you. So first thing I'd like to do, Commissioner, is to move to introduce, because I won't have any more, I don't believe, move to introduce Staff Exhibit 1, which is the final order from 2018-236, if there's no objections.
Do I hear any objections?
No.
Okay. Consider that Staff Exhibit 1.
Thank you. And with that, I would like to move the hearing onto the confidential session, please.
Candace, can you move us to confidential? Okay. And we are back on the record in 2020-00064, and I believe we're going to take a 7-minute break and be back at 12:30. Is that enough time?
Be great. Thank you.
Okay. Okay, we are back on the record. I believe staff has indicated they have about one more additional question for Mr. Smith, and then we'll see if any of the vice chairman has any left.
Yeah, thank you. Can you all hear me?
I think they can hear.
Mr. Smith, can you hear me?
Can anyone hear us?
Yes.
Yes.
Yes, gotcha.
Yes. Mr. Smith, are you there?
I am.
Okay. One question, and I apologize for not asking this earlier. It got pushed off to you from Mr. Berry, so you can thank him. In any of your loan covenants, is there an explicit requirement that upon earning a specific tier or MFIR that triggers a rate case requirement?
No, but if you're below the 1.1 MFIR, you are in default, so you cannot borrow until it is resolved. So I'm not even sure if the filing of an application would resolve that default until you actually had received higher earnings and perhaps even report higher than a 1.1 MFIR.
Let me ask about the timing of that. Your books are as of end year, right? Calendar year. You all close your books. You end up at a 1.09, right? MFIR. Your books still have to be audited. You can make adjustments through the time it's audited. I think that's what Mr. Berry indicated. And all of the reduction in tier to change amortization that you're proposing, everything else, all of those occur when?
Yeah, so we'll get our first preliminary results around the middle of the following month. So around January 15th, we'll see what our preliminary results, and as Vice Chairman had mentioned, 2.1, 2.2 were the last 2 years. That's what we would have seen. And then literally that day we can make the entry. So we'll close our books. By the end of the month, we'll be in good shape to make all our filings, both at the PSC and the RUS, that show kind of the unaudited final results for the prior calendar year. So by the end of January, we've got unaudited.
And that would be the same time in which you would discover you were in violation or in violation of your debt covenants if you didn't meet a 1.1 MFIR.
That's correct.
Okay. And so you would have to take either some action prior to the actual close of the audited books, to bring above a 1.1, or you'd be in violation of it technically, right? You're not in violation when you realize it. You're in violation when your book's closed permanently. Is that correct?
I'm going to have to check and see if we file our unaudited with the lenders beforehand and then have a requirement to update when available. I'm not sure about that on the continuing disclosure that we have with those lenders.
Okay, but it's is it all of your lenders that you'd be in violation of, or particular ones?
Well, I think the indenture covers all of the loans.
Okay.
I'll have to get legal counsel to chime in on that
No,
one.
that's not a problem. So that would put you in violation of them, and in order to not be in violation of your loan covenants, you just have to get the next year would have to be above it, or is it strike one, you're out?
No, so we would be in default. They would not loan us. I will have to look at how we resolve that.
Well, let me ask this question. So in how to cure the default is one thing. Is that explicit in your debt covenants, your loan covenants?
That I don't know.
Are your debt covenants on file with the commission?
They are, and we certainly could follow up with that.
Yeah, and
if I got back to my office.
If we can't find that answer, we'll follow up in a post-hearing data request.
Very
That's all
good.
I have, Commissioner Matthews.
Okay. Vice Chairman, did you have anything additional?
No, I don't think I have anything additional at this point.
Okay. Mr. Depp, did you have redirect?
I do. I think it'll be fairly brief, Your Honor. Mr. Smith, I'm going to back up and try and reframe the forest a little bit here, but is it Big River's position that the settlement agreement that's been presented to the commission as a whole is reasonable?
Most definitely. With the goals that we prioritized, I think that's a fair statement.
Okay, and it's a product of a settlement with the Attorney General and KIUC, correct?
That's correct.
Okay. And does the rural class, there was talk early on in the executive director's questioning about DSM mechanism and the rural class. Does the rural class have a representative counsel, to your knowledge, in this case?
The Attorney General.
Okay. And with respect to the proposed use of that DSM regulatory liability, were there some other factors about the settlement that could help offset the effects that the rural class would feel from that?
Yeah, so I think the couple of things that we thought about at the time was we're talking about the allocation of that DSM regulatory liability. So back to the 75% of it was going there. It's now how do you address the last 100,000? And now we're into the discussion around the large industrial rate design. We're talking about the regulatory exclusions, kind of all those things.
And it's certainly not Big River's position, is it, that everything, that, first of all, Big River's not requesting a change in its revenue requirement, is it?
No, it is not.
It's not seeking to adjust its base rates?
No.
Okay. Do you believe, does the settlement agreement give Big Rivers any discretion, as the new tier credit is applied, to the amortization amounts that will be utilized each year, or is it more of a formula approach?
We're proposing a formulaic approach with then a kind of an incremental acceleration of that amortization. Again, the goal is the investment grade credit rating, and therefore it's how fast can we demonstrate that we're taking down that regulatory asset.
Okay. And I believe there were some questions about the accounting standard, and I won't attempt to see if I wrote down the numbers correctly, but the accounting standard associated with the recovery of what I refer to as the SLIMR, the smelter liability, or smelter loss mitigation regulatory assets. The assets that are associated with those, the physical assets, those have indeed benefited Big River's members for years, haven't they?
That's right. So some of them are the unrecovered net book value of Coleman Station, Reed Unit 1, Station 2, which were placed in service back in the 60s and 70s. The deferred depreciation were more current in the last 7 or 8 years following the 2013.
Okay. And the mechanism that Big Rivers or the parties have proposed as part of the settlement agreement, the new tier credit is tied off of a 1.30 tier. And I believe there's evidence in the record that's roughly an $11 million margin. Is that right?
That's correct.
Okay. Do you have any, I don't know if you do or not, do you have any sense of how that $11 million margin might compare to a typical return on equity that some other IOU similarly sized to Big Rivers might have?
Yeah, so the 1.3 tier at our $37 million of interest on long-term debt is roughly $11 million. At a 9.25% ROE, which is what was granted to a Northern Kentucky IOU recently, that would be equivalent to about $48 million of net margins to Big River. So there's a delta there, $35 to $37 million, roughly 4 times what we're asking for in this particular proceeding.
Okay. And I believe Mr. Walker had in his testimony indicated that Big Rivers and G&Ts in general compete in the credit markets with IOUs. Is that your understanding as well?
Probably more so now than ever with the market turmoil that's out there. We're not investment grade credit. Therefore, the market's almost shut the door on us, unfortunately. So we've got to work a little harder, get to the investment grade, and then compete.
Okay. And Big Rivers in the 2013 rate case, it was approved to receive a 1.30 tier. Is that correct?
That's correct.
Okay. And with respect to the ratings agencies, we know the parties have their views on this. Obviously, the ratings agencies are going to have their views. Your testimony indicated one of the principal objectives of this proceeding is to get its investment grade credit ratings back. That's right?
That's correct.
Okay. If they see the tier, so here we have a tier metric proposed at 1.30. We have a rate case from 7 years ago that authorized a 1.30. And I believe we heard Mr. Berry testify earlier that there's a 1.59 roughly average tier of G&Ts around the country. How do you think rating agencies will react if they see the commission take that tier of 1.30 below that number?
Right. So I think it's fair to say that they're looking at the trend. So the key concept is, are you improving? Are you staying flat? Are you improving? Or are you declining? A 1.3, we can explain why it's not the 1.45 they saw a year ago. I think, right on the margin, noise right around that number is not important. Significantly, a tenth off of it starts to look like we're not nearly as credit quality that the other G&Ts are.
Okay. And is there any reason to think that the credit rating agencies would have a special interest in looking at a tier before that adjustment or after the fact?
No, I think what we sold them on was we were going to make a proposal that would then, on the excess, would include both an amortization expense. So we're accelerating the amortization of the regulatory asset, which they viewed as critical. And then the other side of that was providing a member rate reduction. And they also like the competitiveness aspect of the rate. We're looking at keeping rates under control.
And do you think that's possible because perhaps it gives them a better understanding of the complete picture of Big River's financial activities?
Yeah, I think they're starting to understand exactly where we are, how we're getting out of the hole that we were in, and everyone sees light at the end of the tunnel. So we're right on the verge, and I'm hoping this is the last step.
Okay. There were some questions about what would in a rate case ordinarily be excluded from a cost of service study, but that Big Rivers has proposed to be addressed as part of this settlement agreement. And I think you conceded earlier that, yes, there are some differences between those two. That much is right, correct?
Yes, absolutely.
Okay. And one of those that got a lot of discussion here a few moments ago was pertaining to Touchstone and lobbying and the $400,000 of expenses that are addressed in paragraph 4 of the settlement agreement. So that's economic development expenses, promotional advertising expenses, and Touchstone energy dues. I don't know if you're the best person for this, to answer this or not, but could you perhaps, to get to the vice chairman's emphasis on the prudence of the expenditure in the first place, I think that's a good focus. Could you talk about why those expenditures may be prudent to Big Rivers, if you believe they are?
Yeah, so I had been reminded at the break by Mr. Barry that those are predominantly generation-focused or based fees and dues. So it tends to be, it tends to affect the G&Ts more so than the distribution co-ops. There's also the branding issue of maintaining the rural brand among the members and the equivalent G&T that serves them.
And there was, and I apologize, I'm switching gears here briefly, but there was some discussion as well under questioning from the executive director about the Station 2 settlement. And if I heard right, I'm not intending to put words in his mouth, but that it resulted essentially from a windfall. Do you know what Big Rivers would have earned on that Station 2 if it had not been shut down?
Yeah, as a clarifying comment, the 1.45 was what the forecast had shown without closing Station 2. The KIUC had argued that once we closed the station, there would be surplus earning that we need to pass back to members. And then in the settlement process, what we looked at was the, let's get back down, we'll pass back through the amortization the amount of what our forecast is like with the continued operation of Station 2.
Okay. And on one other topic that came up earlier pertained to employee benefits, and I don't have the chart in front of me, but I expect you may know this off the top of your head. With respect to healthcare coverage, for example, in the past 5 years, could you characterize generally up or down or static whether Big Rivers' portion of contribution to healthcare benefits has generally, what it has done, which direction has it gone, if any?
Yeah, Mr. Urban can explain this in detail, but it's been a continuing increase in the employee contribution for those payments.
Okay. Was it, I don't want to put words in your mouth, so let me just ask this way. The relief that's been requested here, and all the parties have agreed on this, from Big River's perspective, how would you characterize the amount of wiggle room, that's my official legal term, that Big Rivers has in order to achieve its objectives of regaining its investment-grade credit ratings?
Yeah, I think I have to think about a comment on a couple of different ways. One, when we filed, there's been a consistent thing across the three rating agencies. What are you going to do with Coleman Station? What are you going to do with your regulatory assets? What are you going to do with how are you going to be able to maintain rates and recover those assets? And let's eliminate the uncertainty as to the recovery. So those were the key goals of the filing. I will say the pandemic and COVID-19, I do think we were in great shape with this settlement for the upgrade. I do worry that the rating agencies may have introduced a new component of how they're going to evaluate all utilities given the current economic climate.
Okay. And was there ever an alternative consideration to filing the relief sought in this case?
We had talked about filing a base rate increase. So in the Station 2 settlement 2 years ago, our plan was to file that full rate case. But one of the conditions to the AG signing on to that settlement was that we did not increase base rates. So through the process of starting to prepare that filing and looking at what a rate case would look like, we decided that this kind of application proceeding was going to be more cost effective, time effective, and get to what would hopefully be the same result.
And speaking of cost effectiveness, I was involved in that 2013 rate case, and I had to go back and look. And subject to check on this, it looked like from the commission's order, in that case. Last night when I was looking, the rate case expenses that were approved for recovery were in the neighborhood of $1.4 million.
That's right.
Okay.
And that was what was recoverable. There was a considerable amount over that was not recoverable.
Correct. And so that's in 2013 dollars. Without, I don't know that you know the exact number, but how would you characterize the anticipated expense for the present case in relation to that?
I think your billing rate's gone up, Tiff. I think it's probably a little higher now.
But the total, you are correct. I would stipulate my billing rate has gone up. But the total expense of prosecuting this case in comparison to prosecuting the 2013 rate case, can you compare those, what you would anticipate?
I will say this. There's been escalation in costs, but I do think the complexity in this case wouldn't have been the same as the complexity of the smelter case in 2013. So hopefully the effort wouldn't have been as significant, but I do think the cost would be at least as high, if not slightly higher.
Okay. Yeah, if I might have one moment, please. That's all we have at the moment.
Does the Attorney General have any recross?
No, Your Honor.
Does KIUC?
Yes, Your Honor, very briefly, if I could. Mr. Smith, like Mr. Duff, I want to turn you back to sort of the big picture. At the end of 2019, Big Rivers had regulatory assets of $371.9 million. Is that right?
That's correct.
That's money that consumers owe Big Rivers, ratepayers owe Big Rivers.
Inevitably, yes.
Okay. And so what this case does is it recovers, it's a step towards recovering that $371.9 million, plus putting into your cost structure $21 million of depreciation on Wilson, plus about $12 million of ongoing write-off of the regulatory assets, amortization of the regulatory assets. Is that correct?
Correct, yes.
And you've done all of that without raising rates. That's the essence of your structure.
That's correct.
Okay. If the commission approves this settlement, do you believe there's a good possibility, can't know for sure, that Big Rivers will achieve investment grade credit rating?
I do believe that. There's no certainty, no guarantee, but I certainly believe that.
Okay. How much money will consumers save if Big Rivers achieves investment grade credit rating?
So there's several financings coming up or that have recently been approved. On the credit revolver, there's an instantaneous $100,000, roughly $100,000 off of that credit facility. We this summer are planning to refinance the pollution control bonds, which would be an additional about.
Excuse me if I might jump in real quick. Pardon me. This is Tip. I think that the numbers of the savings have been treated as confidential. I wanted to jump in on that.
Thank you.
Well, give me an approximation that you're comfortable with on the public record of saving consumers to achieve investment grade credit status.
Yes, easily between $1 and $2 million a year.
Okay.
We'll be looking to that.
What does that translate into revenue requirements given a 1.3 tier?
It's about 3.7 million per tenth. So it's about a 0.05. So equivalent of a 1.35 or 1.25 is just the delta around the 1.3.
Okay. Big Rivers is a pretty small system, 3.3 million megawatt hours annual sales.
That's correct.
So if you save 3.3 million, that's that's $1 megawatt hour, correct?
That's correct.
So if an average residential customer on the Big River system uses 1,300 kilowatt hours a month, it'd be about $1.30 a month savings to the average residential customer, correct?
That's correct.
Okay.
That's without, just to clarify, that's without the split between the amortization versus member bill credit that would arise from additional surplus.
Is the RUS obligated to refinance half of the $245 million in 2023?
So we have a letter that states the commitment. So I would like to think so. Whether it's enforceable, I would need an attorney to help with, but they have sent the commitment letter that they will.
If that were not legally binding, would an investment grade credit rating make financing that in the public debt markets easier?
It'll most definitely make it easier.
The year 2019 interest on long-term debt was $37 million. It's on your settlement testimony, page 7.
That's correct.
Okay, so at one point here, that translates into margins of $11 million a year.
That's right. 0.3 times the 37 million would get you right at around 11 million.
At a 1.1 tier or MFIR, which is basically the same, it's about $3.7 million of margin per year to Big Rivers.
That's correct.
Okay. And so it's about a $7.3 million difference between 1.3 and 1.1.
That's right. It would drop from 11 to roughly 3.7.
Okay. Normally a lower rate of return or a lower tier helps consumers, but if a 1.1 tier caused you to not get investment grade credit status and your borrowing costs went up, wouldn't lowering the tier hurt consumers?
Yeah, we're not investment grade now. It wouldn't be a good outcome. It just means we won't see the upside in the near term when we're going through the financings that we've talked about. So
And
I would agree with you.
And that $7.3 million annual difference between 1.3 tier and 1.1 tier, that still goes back to consumers, does it not, through a higher member equity ratio?
Yeah, we're certainly going to explore member equity down the road. There's provision in there to look for ways to reduce member rates going forward. So this doesn't close the chapter.
It's not like that $7.3 million is going to a New York bank or equity shareholders from around the country. It stays right with the members, does it not?
That's correct.
Okay. And your financial model does show using the increased member equity is a lump sum write-off on the regulatory asset balance at some future time, correct?
Yes.
Okay. If this were a rate case, by regulation, Big Rivers could not recover promotional advertising, economic development, lobbying, donation, or touchstone energy dues, approximately $500,000 a year, correct?
That's correct.
Okay. The settlement agreement allows Big Rivers to effectively recover promotional advertising, economic development, touchstone energy dues not to exceed $400,000, correct?
Correct.
Okay. And Big Rivers is essentially going to get the lobbying and the donations about, looks like about $160,000 a year, essentially. Is that correct?
Yes.
If this were a rate case, would Big Rivers be asking for the same tier that East Kentucky got of 1.5?
We certainly would be asking for more than a 1.3. That's and I think your fellow G&T here in the state would be a good comparison.
At a 1.5 tier, would that result in margins to Big Rivers of $18.5 million a year at a $37 million long-term debt?
Yep, that's correct.
Okay. And at 1.45, it'd be $16.5 million margins to Big Rivers.
That makes sense. You're right.
So what is it better for consumers to have a lower tier of 1.1 and higher borrowing costs for Big Rivers, or the 1.3 and lower borrowing costs?
Well, I worry when you're referring to a 1.1 because you're kind of on the cliff, and as someone once put it, it's kind of like, how much food do you need to eat in a day? And if I served you, or how much oxygen do you need to breathe? Well, if suddenly you don't get that much oxygen one day, you've got problems. So don't you want a little bit of a reserve margin?
To the extent you have a little reserve, it goes back to your members. It's booked to member equity. It's money that Big Rivers owes the ratepayers.
Well, I think the perfect example is the 91 million that we've talked about here. That's member equity. It's built up over time, and Big Rivers is now passing that back to members, and not asking for that 91 million from them.
In fact, you will use additional member equity to the extent allowed by your debt covenants that to reduce the regulatory assets in the future.
That's exactly right.
So this whole case really started back in 2012, 13 when both smelters changed their wholesale generation supplier, and they still buy their power through Kenergy. Kentucky's not deregulated; they still have to buy through Kenergy, correct?
That's correct.
And you lost they were about 70% of Big River's retail sales at that time, 2012, 2013.
Yeah, well, I know there were well over 50, yes.
Well, they were like 7.3 million megawatt hours a year, and everybody else was 3.3. So it's about 70%, right?
Yes.
Is approving this settlement, in your mind, an important step towards moving forward to regaining status of away from teetering on bankruptcy and away from non-investment grade to being a more stable utility for the state of Kentucky?
Yeah, I think I don't want to mislabel it, because I don't think we're teetering on bankruptcy in any shape or form today. I think we're on the exact opposite end. We're on the pinnacle of, we're just now crossing over. And so it bodes well for the state of Kentucky. It bodes well for the residents and businesses in Western Kentucky.
And I didn't mean to misstate that with that clarification. Thank you. Thank you, Your Honor. No more questions.
Mr. Chandler, do you have any additional recross?
I do not.
Vice Chairman, do you have any?
Just one last question. Mr. Depp touched on healthcare, one of my favorite subjects. And he asked whether the employee participation was going up or down, and I think Mr. Smith said it was going up. And I'm curious what the percentage is for the average employee and their health care. What percentage participation?
Yeah, I will leave that one for Mr. Urban, but as maybe a teaser, I believe it's 12 or north of 12% today. It recently went up, and it was even included in the bargaining agreement, is increasing. But Mr. Urban would know those numbers, I'm sure, off the top of her head.
Okay, thank you.
And Vice Chairman, we can certainly ask Ms. Durbin the question, but I do believe that commission staff's data requests indicate that in 2012, non-bargaining employees pay 12% and an employer pays 88%, and then for the bargaining for generation, employees pay 12.5% and employer pay 87.5%, and then for bargaining transmission, the employees pay 10% and the employer pays 90%, and that's per the response to staff's third request for information, item 7, and then that was, I think that's the one that also identifies that the bargaining contract comes up in a couple of years.
Okay, thanks,
I was
Mr.
going
Chairman.
So we'll get.
I was going to reference
Any
that.
other questions?
Okay, may this witness be excused? Any objection?
I have no objection. I would ask, since there are a couple of questions that he pushed off to Mr. Eckert, that Mr. Smith stay around, in addition to Mr. Berry.
Mr. Smith, are you willing to stick around?
Absolutely.
Okay. You're excused for now.
Thank you.
Your Honor, we have one more witness scheduled to call, subject to whatever the commission determines we need to do with the data request for sponsors.
Okay, just 1 second.
So I would just ask Ms. Vinsel how many questions that she has for her additional witnesses.
Ms. Vinsel?
I've just got really one question for Mr. Barron.
Okay. So
Push through or take a break, Ken?
I would propose that we continue to push through, but I also know that's 1 o'clock and other people may need a break, so I'll defer to the commissioners.
Vice Chairman, do you want to push through or take a break?
I'd like to take about a half-hour break.
Okay.
Could we go ahead and break till 2, Vice Chairman?
Yeah, that's fine.
Okay. We can take a half-hour break then.
Can we go to 1:30 and take a half-hour break then?
Absolutely.
Okay. I think we can get through maybe a witness.
Your Honor, if you'd like to take Mr. Barron out of order, that would be okay if there are more questions for Mr. Walker. Just a suggestion.
We'll just go ahead and take Mr. Walker, I think.
Okay. We call Daniel M. Walker.
Mr. Walker, if you could raise your right hand, please. Could you repeat after me? Do you swear or affirm
Yes.
this testimony you are about to give is true and correct under penalty of perjury?
Yes, it is.
Thank you. Mr. Depp, you may ask. Well, Mr. Walker, if you'd state your name and address for the record as well. Mr. Walker, would you state your name and address for the record, please?
I've lost audio.
Okay.
Yes.
Yeah.
It's Daniel M. Walker, 7106 University Drive, Richmond, Virginia.
Okay, I believe we can hear you now. Mr. Depp, you may ask.
Helps when I turn the mute off. Sorry. Mr. Walker, could you identify your employer or whether you're self-employed, please?
I am president of Walker Associates, a consulting firm.
Thank you. And did you cause testimony in support of the settlement agreement that was filed in this matter to be filed?
Yes, I did.
Thank you. And do you have any revisions or updates to your testimony?
No,
So if I were to ask you those questions today, your responses would be the same as they reflect on paper?
yes.
Witness available for cross.
Mr. West?
We have no questions.
Mr. Kurtz?
No questions, Your Honor.
Mr. Chandler?
Yeah, good, it's afternoon now, Mr. Walker. Good afternoon.
How are you?
Good. In an ordinary rate-making proceeding, what's the purpose of the cushion between a tier required for the loan and the tier target used to calculate rates?
The cushion is one of the measures of risk to the agencies. And their job, of course, is to evaluate risk and assign ratings that correspond to those risks. So if I could just give an example, no cushion would identify considerable risk because there is no leeway in order to stay out of default.
So that's under a rate making, an ordinary revenue requirement paradigm. Is the cushion, all else being equal, is the cushion fundamentally different in an event or in a case such as here, or as you mentioned with ODAC and their 1.2 tier? Is there a fundamental difference in using a tier target for revenue requirement purposes versus a mechanism such as this?
Well, just about every cooperative I know of has, quote, revenue requirements, whether they are regulated or unregulated. And so I think the biggest difference between some co-ops that have minimal cushion and others that have much larger cushion is some of that is used to offset risk, financial risk.
Right, but let me ask you this way. Is there a fundamental difference between the commission using 1.30 to determine the revenue requirements in the 2013 rate case as compared to using 1.3 as the guaranteed tier that Big Rivers will meet in this matter?
I'm not quite sure I get the point of your question. The size of the cushion is always a difference, of course, and whatever risk the cooperative has in its operation.
So let me ask it this way.
Okay.
In setting rates in a regulated rate case, it's based off a number of assumptions. Effectively, all of it are assumptions, correct?
Okay.
And so let's say, last case, Big Rivers anticipates that their sales are going to be X in a given year, and they take that forecast and the commission uses it to determine what rates are required per that forecast to equal a 1.30 tier. Sales come in 20% less, right?
Right.
They aren't going to make their 1.30 tier. In this matter, the proposal before the commission and the settlement is that Big Rivers will meet a 1.30 tier. Isn't that fundamentally different?
Not in terms of evaluating risk. To me, I see it as the same.
You see it as in the same. So an actually guaranteed to meet a 1.3 is equally risky to the risk that you won't meet a 1.3 tier.
No. The fact that you have the ability through your rates to present a consistent earnings and operations through the future is a lot different than being exposed to that risk of not making it. That is dramatically different.
But you would agree that the latter example you just provided has been Big Rivers of the last 7 years, as opposed to the former being what is proposed in this case?
Yes.
Okay. Assuming that credit ratings are objective, and I know that may be a big jump for us here, but assuming that credit ratings are objective, are credit ratings relative to other firms, or are they absolute determinations of creditworthiness of individual firms?
Well, the rating agencies and the potential bondholders make comparisons. And so they may accept an A rating, for example, from one co-op as an indication that their risk may be different, but in sum total, their risks are very much related to another A-rated cooperative.
So bondholders aside, because they have an inherent interest, right, in the risk. I'm talking about an objective credit rating. Is it absolute
Right.
as to the firm's creditworthiness, or is it relative to other firms that compete or that do the same that are in the same industry?
It is relative.
It's all relative. So, so for instance, when the Tax Cuts and Jobs Act came out, would you agree that for the vast majority of utilities that are investor owned, the industry as a whole got downgraded, or almost all of them downgraded because of a reduction in cash flow?
No, I mean, I haven't studied that specifically.
Okay.
So I really,
Okay. So if Big Rivers increases their credit ratings, that's going to have to increase somebody else's credit ratings because they're relative, correct?
no,
So it's objective. So I'm trying to make sure I understand here. Can Big Rivers consistently increase their credit ratings without it being any effect on someone else's credit ratings? The other credit ratings of, for instance, the 25 G&Ts you studied.
right. Well, the trend over time, the trend changes. And Old Dominion, the co-op that I used to work for, experienced that. And so in the beginning, we and only one other cooperative set the standard for what the tier should be. But as additional cooperatives became rated, the rating agencies had more data to work with. And as they were earning greater tiers, then that in essence kind of puts a little bit of pressure on the ones that are not earning at that level to have greater earnings.
So do they publicly indicate that that's the case?
In the write-ups, sometimes they do. You know, they always make in Great Rivers, I know their Moody's report, when they talked about regulation, and they stated in their report that Big Rivers peers are not regulated by state commissions to the extent that Big Rivers is. And so they normally point out, you know, what the relative difference is between a credit they're evaluating and other credits that they look at.
On page 7 of your testimony, and I'll give you a chance to look at that.
Okay? I'm there.
On page 7 of your testimony, on lines, we'll just say the first paragraph in the answer there, you discuss that the average tier for G&Ts with similar risk profile in 2012 was 1.61, and that
Right.
it's 1.63 now, which indicates that the earned tier has increased. So, those are just two data points that are about 1% apart. What other information or evidence do you have that tiers have increased?
Well, what's interesting, I found in looking at the 2 years, is that the distribution of the tiers among the different cooperatives. And what I found was that, for example, if you key off of 1.3, that there are 20 co-ops that earn greater than 1.3 times tier on my list, where in 2012, there were only 15. So, and then I looked at other data points based on 1.6 and 1.4 and so forth. And the same answer held true. The top group of co-ops, if you use my exhibit as an example, most of the tiers were in the top portion. So the group as a whole have moved. So, and I think if you look at a number of data points, you come to the same conclusion.
Well, but that's effectively looking at the difference between
And by
median,
the same thing,
median and average, correct? That your average exceeds your median indicates that the upper 50 percentile is higher from the median than your lower 50 percentile on average.
well, the way I looked at it is the group of co-ops in the top half were earning higher returns than in the bottom half.
Okay.
That's my analysis of it.
But you would agree that, well, so let me say it this way. So you indicate you have additional evidence other than moving 0.02 tier in 8 years that tiers have increased across the board.
Yes.
What was the screen you used for these 25 G&Ts?
Okay. Actually, I'm glad you asked that question. What I did, and I used a similar approach in the 2012 process, is I wanted a collection of G&Ts that would be successful in the market. And so the criteria I used was generally they were rated, because all except in one case, the every other co-op were rated. And that's important for market access, which to me is just as important as cost. And the second is that I know most of these co-ops, and I know how they performed in the market when they go to the market. So that was the second criteria. And another criteria was the fact that they had a market-based, what I call a market-based indenture, which Big Rivers has.
And what do you mean by market-based indenture? That their indenture is for debt other than RUS?
No. What happened historically, and this goes back a few years, but in the beginning, all the G&Ts had, quote, RUS mortgages. And those mortgages provided that the U.S. government called the shots, that they had the primary security interest in the financing. Well, you can see right away that if you're going to the capital markets, you can't expect other lenders in the capital markets to give up their hard-earned dollars if they can't have some level of control. So and that's how Old Dominion got into the capital markets. There were no other alternatives. We either were an RUS borrower or we had to go to the capital markets. And our board decided that the power station we were planning to build was important to its members, and thus we needed to find another source of financing. In order to do that, we had to repay all our RUS debt and extinguish that, and then enter into a market indenture. Now, fortunately, RUS saw the need for its lenders to also have market-based indentures. So probably maybe 10 years ago, RUS started negotiating market-based indentures with its lenders, which allowed the government and any additional lenders to be equal in terms of control on the mortgage indenture.
Okay. How many credit ratings does a G&T generally need to be able to get market credit?
Well, it depends. And I know that's kind of, well, okay, let me back up. I think your question is to enter the capital markets. Because having a credit rating on its own without entering capital markets is only half a step. So if you have very strong credit, like an A, then you could probably, and it depends on which market you are entering. Generally, G&Ts finance under SEC rules. One of them method is called an S1. Then co-ops sometimes finance in a 144A market. And then what has become popular over time is a private placement market. All those have individual rules, SEC rules. So if you talk to a banker, he may tell you, if you're just going to the private placement market, you don't need a ratings. In fact, Wolverine, which is on my list, does not have any ratings. And they've been marginally successful in the capital markets. However, if you have ratings, and they're good ratings, then you can argue when you go to market and you launch a transaction, you can argue with the potential lenders where you should be in your pricing, where you should be in your terms and conditions. So, as I said, unfortunately, it depends.
So that's what I wanted to make sure of. So you're saying that there's still the availability for those that there are opportunities to be able to get credit market rate debt for those G&Ts that are either not rated or rated by one or two agencies.
No, I advise co-ops all the time, and I wouldn't advise Wolverine, and I think they paid the price for it. I would never advise a co-op to enter into the capital markets, either for a credit facility, a short-term credit facility, or a long-term credit facility, unless you had ratings.
At least by two or by three?
It depends.
Okay.
Yeah, I get back to that depends again. The stronger ratings, the more you have, the strong, and they're at an acceptable level, the stronger imprint you're going to have in the market. And something that we haven't talked about is access. When you go to the market, it's usually on one day, and you have to do things. Important thing is you have to make book. And I'm involved in a financing right now, and the concern is the co-op may not make book. And if you don't make book, your interest rates will go up considerably. So you need to make book. You need to finance off your terms and conditions in your indenture, rather than investors trying to impose additional terms and conditions on it. And then you have to finally be able to issue debt at rates that are comparable to other credits in the market with your ratings.
Were you on earlier when Mr. Smith and I were discussing the differences between MFIR and tier?
Yes.
And that he indicated in his testimony that MFIR historically, if it differs from Big River's tier, that it's been that MFIR is higher than their tier. You mentioned on page 8 of your settlement testimony the tier and MFIR of Corn Belt.
Yes.
Are you aware of why their tier was lower, or their MFIR was lower than their tier?
Yes, I am.
Can you tell us why?
There's another category. They include short-term interest in their MFI.
So is that their choice, or is that included in their covenants?
No, it's not included. They're one of my clients. It's not included in any structural document they have. It's their interpretation of the calculation of MFI.
Okay. So do you have any expectation, with your understanding of Big Rivers, that MFIR will be lower than tier in the next few years?
I would have to look at a forecast or and more data than I've seen to know, whether that's true or not.
Do you have an understanding or a belief that credit agencies would believe that the rates set by a utility using a different calculation than the one in their loan covenants is inherently risky?
No, I wouldn't. I'll give you an example. There is one G&T that, excuse me, that uses DSC in their rate setting calculation. And they have the same indenture that Big Rivers has.
But I guess what we were talking about, the benefit of a cushion reducing risk. What good is a cushion if using the exact same numbers you actually meet a tier, but it causes you to miss your MFIR when your MFIR is your debt covenant?
Well, you don't want to do that.
I would agree. I would tend to agree, but that's what I'm asking about, the inherent risk that if the tier credit is using if the credit mechanism proposed is using tier when the debt covenants require a calculation of MFIR, is there an inherent risk of using? Would you agree there's an inherent risk of using that tier insofar as it could differ from the MFIR?
Well, I think the risk is greater if you're talking about setting rates of 1.1.
Well, that's not the premise of the question. The idea is, which is riskier, having a debt covenant with MFIR and using tier as the credit calculation, or having a debt covenant that uses MFIR and using MFIR as the tier as the credit calculation?
Well, there may be a timing difference, or maybe a reason why it's different. Most of the G&Ts, the MFI and the tier are either the same or very close. It's only in a rare situation that you find there's considerable difference between the two.
So in your testimony, you state that something along the lines of that you believe the new tier credit is very likely to be viewed as a credit positive by the credit rating agencies. Would you agree with that?
Absolutely.
Is the 50% over a 1.3 tier that is passed back to customers considered a credit positive, particularly since the regulatory asset balances are a significant credit negative and that Big Rivers maintains its rates are currently competitive?
I think the attractiveness of the Big Rivers proposal is that there's a systematic process and a fairly transparent process on helping to reduce the financial risk of earning less than 1.3, and at the same time reducing the regulatory asset. And the fact that it's fairly easy to understand, you could probably predict what it's going to do in any particular outlook before the agencies. And I think the certainty of it is probably one of the biggest benefits.
Yeah, and I don't, not asking about that. I'm saying specifically as you understand it, or I just want to make sure you understand, the proposal is at a 1.3 tier. Insofar as they exceed that 1.30 tier, half of that savings, half of that margin is passed back as a credit, and the other half is used to reduce, to accelerate the amortization of the regulatory assets. That's how you understand the proposal, correct?
That's correct.
Would you say that that the proposal, based off your experience, that the proposal to pass back half of those margins as a credit to customers is considered a credit positive, a credit negative, or that credit rating agencies will be indifferent?
Now, I think if anything, they'll consider that as a positive. And the reason is that the rating agencies are always looking for balance, and they are, despite what some people may think, they are sensitive to the customer's needs in any particular system. So, to me, I think it would be a credit positive because Big Rivers is, in essence, saying we've got two missions on the excess amount over 1.3. One is to take care of the regulatory assets, the other is to pass back to the members. I might mention here that in the Old Dominion situation, we passed everything over 1.2 back to the members. Of course, Old Dominion did not have a regulatory asset the magnitude that Big Rivers has.
And so, comparatively, would you say that an additional amount over the 1.3, say instead of 50%, it'd be 60 or 70% being used to offset the regulatory assets, would be a credit positive or a credit negative?
I kind of like the 50%. It just, a lot of the rating agencies' impressions are based on feel. Does it feel right? And to me, the 50% feels right.
Yeah, back to my question earlier about we have to assume they're objective, right? That
I think for the most part they are.
Okay. Other than the feels part. I think
They would say that was objective.
Yeah. Commissioner Matthews, those are all the questions I have for Mr. Walker. Thank you, Mr. Walker.
Sure.
Vice Chairman, do you have any questions? Vice Chairman, do you have any questions?
Can you hear me now?
I can.
Good. My only question is in regard to the 50-50 split. Do you have any other opinion besides that it's feel good for the rating agencies?
No, it's part of the balancing proposition that I think is attractive. I think that, I think it also gets to whether the rating agencies are going to feel like that the process will eventually get rid of the regulatory asset. Now, it's conceivable that, they may feel like rather than over the life of the contract, it needs to be extinguished much faster than that. In reading the reports, I don't get that feeling. But at the end of the day, when they're actually presented with the proposal, they may feel like it should be extinguished faster.
I'm going to infer from your answer that at this point there's feel good or not. We're not really certain, but I would guess that if I was a rating agency person, I would want it to be extinguished as quick as possible. I don't have any other questions, Mr. Matthew.
No, I think you're absolutely right. I mean, their attitude is sooner than later.
Thank you.
Mr. Depp, do you have any redirect?
I can be very, very quick. I do.
Okay.
Mr. Walker, if the PSC were to approve a tier mechanism at a level below the current 1.30 that's proposed, do you believe it creates a risk to Big River's ability to regain its investment grade ratings?
I would say not in my lifetime.
Not in your lifetime that they would regain them?
Yeah. If
Okay.
if it were less than 1.30,
Okay.
it makes it a much harder hill to climb.
Okay,
And-
thank you.
Okay.
And then the last question for you is just we talked about the sense of feel that you have for the ratings agencies. Can you just give the commission some sense of the years of experience and the depth of experience that you've had in the financial and utility regulation field that helps inform that sense of feel?
Yes. I was Director of Accounting and Finance for the Virginia Commission for almost 10 years. So, and in that capacity, we had to evaluate the debt and finance instruments of all the regulated utilities in Virginia. Then for 20 years, I was Chief Financial Officer for Old Dominion Electric. And as I indicated, we were the second co-op to finance all our assets in the capital markets, which required debt ratings. So I had 20 years of experience there with the debt ratings. And since I retired from Old Dominion for the last 10 years, I have been advising co-ops and meeting with rating agencies and advising in actual capital markets financing. So I believe if my math is correct, that's 40 years. And I feel every bit of it.
Thank you, Mr. Walker. No further questions, Your Honor.
AG, did you have any recross?
No, Your Honor.
Mr. Kurtz, did you have any recross?
Thank you. Very briefly, Mr. Walker, if the commission approved the 50-50 split in this case, based on your understanding of rate making, would that be set in stone through the year 2043 when the member contracts expire, or could that be modified at some point mid-course if the regulatory asset did not look like it was getting written down fast enough?
I presume it could be modified.
Thank you, Your Honor. No more questions.
Mr. Chandler, last bite at the apple.
No, thank you.
Mr. Cicero, last bite at the apple.
No, thank you.
May this witness be excused?
Yes, ma'am.
Thank you, Mr. Walker, and you are excused.
Thank you very much. Have a good day.
Thanks. I would propose that we take that half an hour break now.
Do you want to do 45 minutes? You can do a phone call.
Okay.
So we'll be back at 2:15.
All right.
Thank you.
Thank you.
Hi, I think we are back on the record in 2020-64. I believe we are on staff and intervener. We're going to ask which witnesses you want because I think
I think
Mr. Depp, you are finished with your witnesses, correct?
well,
Well, nearly so. Now, thank you for turning to me. I was going to ask this is a little bit out of the ordinary, but in light of all the questions we've had about the various details, there was really one important part of the direct testimony, and I'll give the reference now. So if the executive director and others want to pull it up, it's Mr. Berry's testimony application to the application in support of the application, Exhibit D at page 26. There were a lot of questions about Big River's efforts to get its investment grade credit rating back. And in that testimony, just while folks are looking for it, because Big Rivers does not have 2 investment grade ratings, however, and despite the fact that it's operating under corrective action plan under its RUS loan contract to restore at least 2 investment grade ratings, RUS has the right at any time to direct Big Rivers to deposit all cash proceeds from its assets, except cash proceeds deposited are required to be deposited with the trustee pursuant to the indenture into a segregated account pursuant to the lockbox agreement attached to the 2009 RUS loan contract. If there were any questions, I wanted to make sure, I don't often put a witness back on, but make sure that everyone knew Mr. Berry is available to take questions on it as needed.
I don't have anything on it.
Ms. Vinsel, do you have a question? I believe this was Mr. Berry was your witness, correct?
That's correct. No, I have no further questions for Mr. Berry.
Mr. West?
No questions.
Mr. Kurtz? Mr. Bain?
Yes, really quickly. I've never understood what the lockbox provision is, but obviously, presumably it's bad. What is it and why is it bad?
You want to remind Mr. Berry he's still under oath?
Yeah, Mr. Berry, you're still under oath.
Okay. Our loan covenants require us to maintain 2 investment grade credit ratings. If we do not, then we have to file a corrective action plan, and the RUS has the ability to either accept our plan or it may not be acceptable to RUS. And the lockbox basically means RUS just comes in and takes over Big Rivers and takes over the assets and runs Big Rivers, sells Big Rivers, whatever they so desire to do with Big Rivers.
Thank you, Your Honor.
Mr. Chandler?
We don't have any questions for Mr. Berry. I think the next witness that we would have questions for are Mr. Chambliss, Mr. Pullen, Mr. Eckert, and Ms. Durbin, however, Mr. Depp would like to call them.
I have a question.
I was getting to you next, sir. Mr. Vice Chairman?
Thank you. So, Mr. Berry, well, Russ has the ability to do that, like any good business, as long as the covenants are set up and followed by those that are under them, which in this case is Big Rivers Electric, and you're doing your job and they're happy with it. There's probably slim to no chance that Russ would come in and exercise a lockbox clause. Is that correct?
As long as we're in compliance with all our covenants, then they don't have that the ability or the right to do that. But because we only have 1 investment grade credit rating, they do have the ability to do that. Now, I don't think they will do it as long as, because what we've seen over time is Big Rivers, from the first corrective action plan we filed till today, you've seen improvement year over year. You know, we were 2 grades below investment grade, or 2 notches below investment grade. We were negative watch, so we went from negative to stable to positive, and now we've regained 1 in the investment grade credit rating. So year over year, they've seen progress. But I think if it gets to the point where we're not making progress again, I do think that they would come in and do something. I know some of you remember, I know Commissioner Matthews remembers many years ago when the commission disallowed us to put Wilson in our rates, base rates. RUS came in and suspended borrowing to all co-ops across the whole state. So they're not beyond doing it. But as long as we're doing what we say we're going to do and they see that gradual improvement, then I think they will not do that.
How often do you speak to the representatives of Russ about your situation?
Well, we file an updated corrective action plan annually, but Mr. Smith is in communication with them, many times throughout the year. I'm going to say at least a minimum of every couple of months.
Right. My only point is, as long as you're doing what you're supposed to do, the lockbox clause is highly unlikely to be exercised. I mean, you would have to really fall backwards.
Yeah, I mean, it's at their discretion is the
Mm-hmm.
I don't disagree with it, but it's at their discretion.
Everybody protects themselves, which is why legal agreements tend to be so long and why we have so many lawyers, because there's always protecting ourselves to the nth degree. And I understand the covenants that are in documents like that. I also dealt with a lot of bankruptcies, and the one thing that a creditor wants to receive is his money, and he wants to do it in a way that sustains the business that he's trying to support, or there probably wouldn't have been an agreement in the first place.
Okay.
That's all I have.
I was going to ask, was that a question?
It was kind of a rhetorical question. How's that?
Okay.
Well, if staff,
Go ahead.
I was going to say, if staff doesn't have a preference, Mike Chambliss may not be a fan of this, but I usually default to alphabetical order by last name.
Well, I think staff had indicated that perhaps Mr. Barron would be a short witness.
We'd have no objection to that.
That's true. I just have one question for Mr. Barron.
Mr. Barron, are you on and willing to go?
Yes.
Can you raise your right hand, please?
Yes, ma'am.
Do you swear or affirm that the testimony you're about to give is true and correct under penalty of perjury?
Yes, I do.
Please state your name and address for the record.
Stephen J. Barron, J. Kennedy and Associates, Inc., 570 Colonial Park Drive, Suite 305, Roswell, Georgia, 30075.
Mr. Kurtz, you may ask.
Thank you, Your Honor. Mr. Barron, did you prepare under your direct supervision, direct testimony and settlement testimony?
Yes, I did.
Do you have any changes or corrections you'd like to make to the testimony?
No, I don't.
If I were to ask you the same questions as those contained therein, would your answers be the same?
Yes, I would.
Your Honor, I tender the witness for cross.
Okay. Ms. Benzel?
Thank you, Commissioner Matthews. Good afternoon, Mr. Barron.
Good afternoon.
One of the settlement provisions is that the proposed rate design for the large industrial class would not apply to fossil fuel industries, and the fossil fuel industries would continue to be served under the current large industrial customer rate, correct?
Yes.
Did you prepare a cost justification to determine that fossil fuel industries should be exempt from the large industrial class rate design?
No, I did not. It was, first of all, I guess it was an agreed upon provision of the settlement. And to the best of my knowledge, I think there was only, other than the coal mines, if you're referring to the non-coal mines, or are you referring to all of them, coal mines and other
Pardon me, I didn't mean to talk over you. In your settlement testimony, you speak specifically about fossil fuel industries.
Yes, and in that context, it would include both primarily the coal mines, but there was one oil industry customer, I believe. And so if I could, just in response to your actual question, I did not do any specific analysis. And I had, if you recall, in my direct testimony under the original proposal, I had made a similar recommendation with respect to the coal mines. And it really was, it was related to the fact that a number of them were in bankruptcy. They had very, very low load factors because of the economic environment in which they're operating. They just weren't using much electricity. They had high demands, and the rate design, the cost-based rate design that we were proposing, and the cost-based rate design that we're recommending that's included in the settlement, would have impacted them because of their low load factor. The settlement proposal is based on cost. Notwithstanding that, the coal mines, given their economic situation in particular, would have been impacted. And at this point in time, it appeared, I mean, it was almost self-evident that that was a proper approach.
Thank you. I think you've answered my question. I have no further questions at this time. I'm going to double check with my colleagues, though, by
Okay.
text.
Mr. Depp, did you have questions?
I might do one quick one, Your Honor, please. Mr. Barron, thanks. Are you aware, I don't know if you're aware of a data request response, a post-informal conference data request response filed by KIUC on May the 28th of this year?
Yes, is that the staff's post-conference data request?
Yes, it is. And I believe as the last part of that on page 5, and some of the information, the actual customers are confidential. I'm not going to get into that. Staff will be able to see who those are because they have the confidential document. But do you see on the far right side of that page an estimation of impact of the various customers served there?
Yes.
And you don't have any reason to disagree with those numbers, do you?
No.
Thank you. No further questions, Your Honor.
Thank you. Mr. West?
We don't have any questions. This witness.
Mr. Cicero?
You not have any questions?
Then may this witness be excused?
Yes.
Okay. Mr. Barron, thank you. You didn't have to fly to Kentucky for that.
We saved KIUC some money on airline fares. Thank you.
Mr. Kurtz, did you have any redirect? I neglected to ask you.
No, I do not. Thank you.
Thank you. You feel free to tell me when I forget to do that.
Your Honor, is it okay then for me to sign off from the hearing?
I think you are excused. Yes.
Thank you.
Mr. Depp, I believe we were getting ready to introduce Mr. Chambliss.
That's fine with us. Yes, please.
Mr. Chambliss, would you raise your right hand, please? Do you swear or affirm the testimony you're about to give is true and correct under penalty of perjury?
Yes, I do.
Thank you. Your name and address for the record, please.
My name is Michael W. Chambliss. My business address is 201 3rd Street, Henderson, Kentucky, 42420.
Mr. Depp, you may ask.
Thank you. Mr. Chambliss, what's your title at Big Rivers?
I'm the Vice President, System Operations.
Thank you. And did you sponsor certain data request responses that were filed in this proceeding?
Yes, I did.
And do you have any revisions or updates to those responses?
No, I don't.
And if I were to ask you those questions today, would your responses to them be the same?
Yes, they would.
Witnesses available for cross.
Thank
Mr.
you.
West,
No questions.
Mr. Kurtz,
No questions, Your Honor.
Mr. Chandler.
Yes, ma'am. I believe that Ms. Vinsel may have dropped the hearing, so she may be unavailable for the next few minutes. She lost power. Although I don't think she lives in Meads territory, so it's not Big River's fault, certainly. Good afternoon, Mr. Chambliss.
Good afternoon.
Well, I think to kick it off, I think I'm going to have to ask to go onto the confidential record. I don't know that I can lay any foundation on the public record, so I would move that we do so.
We'll go into confidential session, our regular session, and introduce the witness. You're ready. Okay, and we are ready. We're back on the record in 2020-0064. I believe, Mr. Depp, you were calling Ms. Durbin.
Correct. Thank you.
Ms. Durbin, if you would raise your right hand, please. Do you swear or affirm that the testimony you're about to give is true and correct under penalty of perjury?
I do.
If you would state your name and address for the record, please.
Lindsay Durbin, 201 3rd Street, Henderson, Kentucky, 42420.
Mr. Depp, you may ask.
Thank you. Ms. Durbin, could you state your title at Big Rivers, please?
Vice President, Human Resources.
Thank you. And did you sponsor some data request responses that were filed in this case?
I did.
Do you have any revisions or updates to those responses?
I do not.
So if I were to ask you those questions today, your responses would be the same?
They would.
Thank you. The witness is available for cross.
And Commissioner, can I just ask, before we move on to cross, can I ask Jim to go back to see everyone and wait for Ms. Vinsel when her power got cut off and we go into confidential session? It excludes her from joining, so she's trying to join now. I apologize.
Jim, can we go back to see everyone?
Let me make sure that he unlocks it.
Just be patient. Technology's great when it works. Mr. West, did you have anything while we were getting people sitting down here?
No, I do not.
Mr. Kurtz?
No questions.
So, Mr. Chandler, do we need to go into confidential session before you ask?
Yeah, I would like to move Commissioner to a confidential session now that Ms. Vinsel is back.
Okay. Candace, if we could go back into... I'm showing my age and how long I've been here. Okay. We are back on the record in 2020-0064. Mr. Depp?
Big Rivers calls Mark Ekert.
Mr. Ekert, if you could raise your right hand, please. Do you swear or affirm that the testimony you're about to give is true and correct under penalty of perjury?
Yes, I do.
Could you please state your name and address for the record?
Mark Akrit, 201 3rd Street, Henderson, Kentucky, 42420.
Mr. Depp, you may ask.
Thank you. Mr. Ekert, what's your title at Big Rivers?
VP of Energy Services.
And did you sponsor certain responses to data requests that were issued in this matter?
Yes, I did.
And do you have any revisions or updates to those responses?
No, I do not.
And if I were to ask you those same questions today, would you respond the same?
Yes, I would.
Witnesses available for cross.
Mr. West?
We have no questions for this witness.
Mr. Kurtz?
No questions, Your Honor.
Mr. Chandler?
Just a few. Good afternoon, Mr. Eckert.
Good afternoon.
You'll be happy to know I came in today without having any questions for you, so you can blame Mr. Smith this evening.
Excellent.
I think, again, Commissioner, all of the questions I have for Mr. Eckert will be confidential, so I'd like to move on to the confidential session.
If we could go on to the confidential session, please. We are back on the record in 2020-00064. If you would raise your right hand, please. Do you swear or affirm the testimony you're about to give is true and correct under penalty of perjury?
I do.
Could you please state your name and address for the record?
Michael T. Pullen, 201 3rd Street, Henderson, Kentucky, 42420.
Mr. Depp, you may ask.
Thank you. Thank you. Mr. Pullen, what's your title with Big Rivers?
Executive Vice President, Operations.
Thank you. And did you sponsor certain data request responses that were filed in this matter?
Yes,
Do you have any revisions or updates to those responses?
I do not.
And if you were to be asked those again today, your responses would be the same, I take it?
Yes.
Thank you. Witnesses available for cross.
Mr. Chandler.
Yeah, can I ask that we go in the confidential session?
Thank you. We are going to go into confidential session again. Okay, we are back on the record in 2020-00064, and I believe we want to ask Mr. Berry to come back.
I'm here, Your Honor.
Remember, you are still under oath.
I would ask Commissioner, so all of the questions for Mr. Berry now have almost all been deferred from the other people that I had to cross. Does counsel have an objection to me asking those questions of Mr. Berry?
No, no objection.
Thanks, Commissioner. To the question, Mr. Berry, to the question that was asked from Mr. Pullen earlier, or in that neighborhood, does the dependence is the wrong word, but the significant amount of megawatts that make up Big River's fleet that are coal-fired, does that raise the credit risk or make it harder to get investment-grade credit ratings from credit rating agencies?
If you will look at the reports from the credit rating agencies, being heavily coal-fired is a negative to them, which is why we've continued to try to balance our portfolio and have a more diverse portfolio. And I think you've seen some announcements where we're changing up some of our power supply options.
Okay. One of the questions earlier was about on the about how the board's per diem for training was calculated or was determined. Are those pre-approved programs that are set out at the beginning of the year, or are there parameters around them, or do people identify what type of training they would like to participate in and then the board subsequently approve it or deny it?
The board submits what training that they would like to do during the year, and then the board subsequently approves it or denies it.
Are there any rules that currently put guardrails on what type of training can be approved, or is it just ad hoc?
No, actually, the training is really, let me try to expand a little bit on it. First, you have the training that's done through our statewide organization, KAEC, and NRECA, the national organization. And that's training for board members and board directors. It's specific training for keeping them involved and knowledgeable about the industry and what questions they should be asking in the boardroom and things to make them a better director. So you have those two items. Then you have items that on the KAEC, myself and one director is on that KAEC board, as well as we're a member owner of ACES Power Marketing. So myself and one of the board members is also on the ACES board. So some of those are not training, it's where they're actually attending, participating in the board members as a director.
Do you remember the discussion earlier about the, as Big Rivers refers to them, the regulatory exclusions?
Yes.
Would you agree that the vast majority of those that were expended in 2019 were not done so in accordance with a contract, or were not required to be expended in terms of a contract?
Oh, I'm sorry, I may have misspoke. So
So I'll take a step back.
refresh my-
So the
Yes.
political advertising, lobbying, economic development, the group of $500,000 to $600,000 of expenses that were incurred in 2019 that I think you all have deemed regulatory exclusions. Would you agree that the vast majority of those are not determined by a requirement under any contract?
Yes, I agree with that.
Okay. And that I think the word I used, and I think maybe Mr. Smith may have disagreed, but that, well, I'll try not to use the word again. That they're at management's discretion for the most part.
Yeah. So do you want to talk about one specific charge, or is it just all inclusive?
Well, so I'm trying to understand. So I can't find any of them that would seem to would arise out of a contractual requirement. I think, for instance, there are costs that were discussed earlier for bargaining units, for bargaining employees who might have two contributions to different retirement. It could be argued at least one of those is done. Those contributions are done pursuant to a contract or some contractual requirement, right? As it relates to the 2019 expenses that were provided in the record, the donations, Touchstone Energy dues, KEC dues, a number of them. Are you aware of any of them that arise under a requirement or under contract?
No, it's not under contract. The Big Rivers has provided or paid the Touchstone Energy dues for our members for many, many years, because it's based really on our generation to begin with. And including in that fee what the members get, which we help through our member services organization here at Big Rivers, is they take Touchstone Energy does all of the satisfaction surveys for the member cooperatives, and so that's why it's it's centrally done to try to get a little bit of economies of scale from that perspective as well. So while it's not contractual, that's been something that we've done. And I think you may have asked, Mr. Chandler, does all of the co-ops in the state, so all of the distribution co-ops that are regulated by the Public Service Commission are members of and pay Touchstone Energy dues.
So let me ask it this way, and beneficial preferential aside, would you agree that of the $500 to $600 of what has been deemed regulatory exclusions at the outset by Big Rivers, would you agree that those costs are not required to provide service?
Yeah, I would say that they're probably not required.
Okay.
But we do think, obviously, we think they provide a benefit, or we wouldn't be doing those.
I wanted to say, management preference aside, I just want to make sure that we're on the same page about required for the provision of service. Those are all the questions I have, Commissioner Matthews. Thank you, Mr. Berry.
Vice Chairman, do you have any questions?
I do not have any additional questions for Mr. Berry. Thank you, Mr. Berry.
Thank you.
I think I have one, and this it may be one that we have to put into a post-hearing data request for someone else. The provision, well, let me make sure I can ask. The per kilowatt versus the flat, it's not confidential.
So that's a proposal?
Yeah. It's not confidential.
That settlement agreement proposes per meter instead of per kilowatt.
Not confidential, I can ask it now.
That's the question.
If I have a question, we'll put it in the post-hearing data request.
Okay.
Mr. Depp, did you have any recross?
Can I, just one very,
Redirect.
very brief one. Thank you. One brief one. Mr. Berry, did economic development expenses and these expenses generally, did they help you grow your load under your load mitigation plan?
Absolutely. If you look at what we've been able to do since the smelters left our system in 2013, we essentially tripled the load of an expansion in our territory, which is one of the largest expansions ever in the state, as well as we've landed the Nucor project, which is by far the largest project in the state in probably 25 years.
Thank you. No further questions.
Can I ask one last question?
Yes.
Mr. Berry, you refer to the Nucor project and maybe some other ancillary projects, but the contributions being made to economic development are going to the 3 co-ops and the economic development authorities in those local areas. How much did those contribute to bringing in something like Nucor? Were those dollars spent on those types of projects, or was that at a higher level?
No, much of the funding that we provide in the service territory is for the member owners to be board members or participants on the local economic development cabinets, and so that they can be very active and can be in tune in helping the local economic development corporations have the tools that they need and do some of the things. For instance, where we've done drone, we've taken drone and performed flyovers in the, I'm hearing some background noise, I apologize. But we've done these drone flyovers to help promote certain properties for projects like Nucor, and then there's a couple of projects in the Paducah area as well.
For the Nucor project, were the only funds that were used for economic development out of the funds that are identified as being the 107,000, or let me see here, how much was it? Well, I'll put it in a range since it's on this file, 150 to 175,000. Those were actually those show up for 2020, so they aren't even for past years. Were there other funds that were used besides those?
No, it's just those funds, and those funds, the total amount that was used across our entire 22 county footprint. That's not just for Nucor.
Right, but I just wondered if, I understand that those are going to develop on a local basis. I'm just looking at the Nucor project in particular. If there was some, Nucor has been brought up a couple of times during this testimony today, and I'm curious if there's any other funds that were spent to bring in Nucor other than this development money that's referred to in this. You're excluded from it.
I'm sorry, Vice Chairman, you broke up there, and so I didn't hear all of that question.
I'm just curious if there's any other funds that are being used besides the funds identified for those 3 localities for Nucor.
No, sir.
Okay. All right. All right. Thank you. I don't have any other questions. Thank you, Mr. Berry.
Thank you, Mr. Berry. Pending someone speaking up, I don't believe anybody else has any questions. You're excused again. Does anybody have any additional witnesses? Mr. Depp?
No, Your Honor.
Mr. West, Mr. Kurtz,
No witnesses for us.
Ms. Vinsel, Mr. Chandler.
No, Your Honor.
I guess.
Sorry, I was slow on the draw.
I anticipated that you did not. Okay, I guess now we need to talk about scheduling of these post-hearing data requests, of which there are a few. And staff does issue those in written form. When can we get those, Ms. Vinsel, Mr. Chandler?
I'll defer to Ms. Vinsel, but I think end of the day tomorrow is at the latest.
Okay, so by June
Yes.
10?
Yes, I've got them prepared, so they'll be ready to go tomorrow.
And how long do you believe the witnesses will need to respond to those?
Well, how long they need and how long they'll have are two separate things.
I was gonna give him the first option, which was how long do you think they need, Mr. Depp?
I've got in my head, for whatever reason, that if we respond by next Wednesday, we very well may be able to do it sooner, and we're certainly not going to hold it up just to be holding it up, because we've asked for an expedited decision. So next Wednesday, with the idea that we would perhaps get it sooner, would be fine.
Does that work for you, Ms. Vinsel?
That works.
Okay. Staff, do you believe there will be any briefs?
Staff does not believe that there will be a need for briefs.
Mr. Depp, do you agree with
Well,
that?
I was going to propose if we could have a short brief, just probably by the end of next week, if that would work.
The 19th
Yes, please.
is, can you get it in by the 17th? I know that's pushing you, but the staff is gonna need time to get an order if we're gonna get it out by the 29th. And
I
getting a
understand.
brief on the 19th won't give us enough time, unfortunately.
Let's do the 17th.
And if anyone else files briefs, they will be simultaneous, also due on the 17th. Correct?
Yes.
And
Yeah, I don't see the need for anybody to respond since all of the parties are on the same page, right?
respond to.
The initial,
Right, yeah,
the
I
briefs.
the 17th will end the record, how's that? Ms. Vinsel, do we need to do the settlement questions where I ask everyone
Yes.
to repeat
Yes,
after
we do.
me or to answer affirmatively?
Yes, we do. And I do believe that you have them with you.
I do, I have them, yes. And I will ask them of everyone simultaneously, and if we could get responses back from each of the parties at the end of each question, that would be wonderful. This one is gonna really, technology is either gonna work on this or it's not, so. So if you would raise your hand. Were you aware of and did you have an opportunity to participate in all of the negotiations that resulted in the settlement agreement?
Yes.
Yes.
Did you voluntarily sign the settlement agreement and do you fully support each and every provision contained therein?
Yes. Yes.
Are there any provisions in the settlement agreement that you do not understand, object to, or take issue with?
No.
No.
Was any consideration of any kind offered, or were any promises made other than what was expressly set forth in the settlement agreement to induce you to negotiate and sign the settlement agreement?
No.
Are you aware of any reason why the commission should not adopt and approve the settlement agreement in its entirety?
No.
Thank you. That is the end of the questions. And I think that's the end of the hearing. I think we can adjourn, correct? Mr. Chandler, Ms. Vinsel?
Correct?
Thank you very much. And this meeting is adjourned. Ooh, I get the, this
Good
meeting
one.
is adjourned.
Thank